Eastern bell rings in New York. The selling begins, and it basically continues up until about 3 Eastern, the final hour before things stabilize. Ultimately, it's a day where the S&P 500 loses 2.55%, the Nasdaq's off by 2.6, Dow Jones off 2.65, and the Russell a little bit better at 2.23% lower. Of course, the day is largely defined by that sell America mindset. Bonds are still trading heavy and to the downside, particularly the longer end of the curve. You see that gold surges over 3% to a new all-time high. Silver catching a bid likewise. And the relentless selling of the U.S. dollar continues. Energy sector not liking that for the most part. Dylan, what's the view from abroad here as we entered the short holiday week?
I think it's sort of more sadness than anything else. I think it's more, sadness and disbelief, I guess I would say. People understand the logic that Trump perceives that his voters are not the financial class, and they're not the executive class, and they're not the Wall Street class. They are the disenfranchised American, non-investor who lost manufacturing jobs. And I think it's like a game of the question is, can Donald Trump basically alienate the financial class, the investor class, and the stock market class, alienate the world, and in the process reinvigorate American domestic manufacturing and middle-class jobs? It seems like a long shot. And certainly from the perspective, and I think that's why it's viewed from an overseas perspective with disbelief. I think it's not even disbelief so much about Trump at this point. It's disbelief that the Republican Party and the people around Trump are indulging this destruction.
Ilya, we make our way into a second half of the day where we get a bounce off the levels that we were talking about around Futures Power Hour, roughly 51.40 or so, as we made our way through that session. Is anything more than a dead cat bounce on a thin volume holiday Monday?
I think that's what I was asking myself as I was looking here toward the close here and thinking, okay, maybe we get a little bit more of a bounce as liquidity comes back in. Ultimately, volatility still looked very expensive, and it was very difficult to find shorts that made sense from a kind of basic risk-reward perspective, even sizing up verticals. And so I wonder what happens now. I think the lack of liquidity was a big contributor today, as we've talked about before. Obviously, Europe was closed for Easter Monday, so was Australia, so was Hong Kong. China and Japan were open as far as sort of the larger-ish markets. Japan, obviously, much larger than China. But other than that, things were pretty thin. So I wonder if we don't get a little bit of unclenching still and get an opportunity to sell into this. But I think when you look at the way, for example, 4-hour charts, 8-hour charts, and the major indexes look, the sell-off appears to have resumed. I'm not at this point thinking the time to sell isn't now. I'm thinking, can I get a better level to sell from? But it looks like we're going to come back to retest lows from earlier in the month, the way things are setting up here. I only have exposure in the Russell at this point because it made the breakdown a little bit earlier, but it obviously didn't have as much follow through today. So I'm looking to be a seller of the S&P. I'm looking to be a seller of NASDAQ. Maybe I'll get a better crack at it tomorrow.
When you say looking to be, Ilya, are you suggesting that you think that there's room for some sort of a dead cat bounce? You're hopeful. Yeah.
I'm hopeful that when liquidity comes back after this big absence, this big gap on Monday, Europe was absent, Australia was absent, Hong Kong was absent. So tons of liquidity was off the board. I'm hoping when it comes back in, some degree of opportunism gives us a little bit of a lift after that kind of a sell-off, and I get something to sell into.
I mean, everywhere was red today for what it's worth. I mean, no matter, I think Indian stock markets and Chinese stock markets were slightly higher over the course of the session, like FXI is
Hong Kong was closed, so and FXI is Hong Kong. So ASHR, if you have a look,
0.67%.
Yeah,
right. It's substantial, but everywhere else,
not the worst.
Things are closed. So,
yeah,
what do you make of it? Either way, I think the point that you get across is that it's just a really bad risk-off day. Yes. Markets are bleeding lower, and a lot of that acceleration, because markets are closed for the most part in Europe, you can see how overnight futures trading is just kind of like melting and grinding to the downside. As soon as U.S. cash equities open up, that's when the selling really accelerates and begins. And it's because the news flow over the weekend was just kind of down and dour. President Trump's out talking about Fed Chair Powell. I mean, I do think the silver lining to all this is that if he really just wanted to fire Powell, then Powell had already been fired. We've gone through 5 IRS commissioners since he was inaugurated, right? So clearly it's not about getting rid of him.
I don't even say this with the political, obviously sure. I have an opinion, but I just wonder the degree to which when the President of the United States issues an Easter message like this president did, like it just creates a sense of a lack of coherent leadership for the United States. Even if you love President Donald Trump, do you want your president offering Easter messages like that? It just doesn't make any sense. It just seems to me that it's just an indication of the fact that America has is to be the marginal decision relative to America, whether it's as a tourist or a business person or as a currency trader, is to move away because it's an odd situation.
Yeah,
whether it's canceling your vacation, selling your dollars, or redirecting your business development, all of the marginal decisions are away from the United States.
Yeah, so the generous interpretation is that everybody has looked at the U.S. and said, "Okay, wait and see mode."
Mm-hmm. Yeah,
and that's sort of the most generous,
That's the kindest and most benevolent perspective.
Yeah. You could say, okay, well, they're just waiting for this thing to work out or not work out, but they're not giving it the benefit of doubt. And that's sort of the nicest you could say it.
Isn't the most alarming thing about the market now that Bitcoin is moving up with gold to such a degree? While the dollar's selling off, Ilya? It feels like it was remarkably stable, and it's now
not what you want to
serving, kind of serving as a capital flight vehicle.
Well, the dollar is getting crushed, so anything denominated in dollars is going to have a level of support. That Bitcoin is sort of popping to the top of its recent relatively lowish range is absolutely eye-catching. I wouldn't say it's something that suggests that sort of the architecture of the TradFi financial system is cracking, but the forces being unleashed here could actually see something like that become a credible story.
Dylan, am I losing my mind watching gold and Bitcoin perform the way that they are in a market that's seeing the NASDAQ bleed 2.5%? One of the worst days that we've seen across the board since September 22. Isn't Bitcoin supposed to be a risk asset? Why on earth is it holding up?
I think you're asking an interesting question, which is, is this a moment where Bitcoin grows up into being first of all, what was the original Bitcoin conception was a non-state currency. Right. It was out of the financial crisis, a different way to denominate flow of payments that is not state controlled, all the things that we blah, blah, blah.
Mm-hmm.
We're now at a moment where the US dollar is into a weakening trend, maybe a secular permanent trend to a less relevant currency. Maybe it's just a bad month, but there's enough news flow to support speculation that it's more than a bad month, although it might end up just being a bad month. But there's enough news flow to drive that speculation. If the dollar is less powerful, which is the basic argument, then what is the alternative? And we've been through this 1,000 times, and it's not going to be the euro for the reasons because of no fiscal union, blah, blah. Anyway, is Bitcoin the alternative? No, but it is behaving like a risk-off asset at the moment, which is peculiar for its history. I mean, the other thing is because Donald Trump is privately so invested in the establishment of his own crypto world, it may be in Donald Trump's personal interests for the U.S. dollar to become less valuable, such that he hopes that the Trump coin can become the new global reserve currency. I'm not saying that that's what's going to happen. I'm saying that's the sort of thing that comes out of this man's mouth that he's capable of thinking.
I can't help but wonder that if we get some sort of, and I tweeted this out years ago, that Trump was the first MMT president, and I didn't get many likes on that tweet. I thought it was a pretty sharp insight for how he's behaving into the COVID years. And so I think I'll say it again. Trump is an MMT president. In his world, we'd have blown out fiscal deficits and interest rates pinned at zero and the yield curve fixed by a FOMC that he controls. Isn't that around the corner here, Ilya? Like, if we game out, let's just say Trump gets Powell's gone next month, a year from now. He's going to get Kevin Warsh in there. He gets one of his guys in there, Kevin Hassett, Scott Bessent, who knows, Don Jr. He's going to get someone that's going to implement the policy that he wants, or try to.
Mm-hmm.
Isn't that Federal Reserve going to have to be angling towards yield curve control to provide the monetary policy offset that fiscal needs to detox the economy?
That's if you get a compliant Federal Reserve, but you don't have that kind of architecture. And
Why not?
Because the litigious nature of the United States is sometimes a burden and sometimes one of the greatest assets that the system has. Because it prevents rapid shifts to chaos to some extent and prevents singular actors from riding roughshod over everything the way, let's say, a Recep Tayyip Erdogan might in Turkey, where those same guardrails don't exist, and that bureaucratic morass doesn't exist to the same extent. The bureaucratic morass is, in this case, a moderating force, as it were. The president has already floated the idea of firing the Fed chair. Powell has very clearly said, I will not resign if asked, and I will fight being fired because it is against the law to do it. Which means this is all going to get locked up in courts for extended periods of time. In the meantime, as you and I were talking earlier today, Chris, let's say he fires Powell from the chairmanship. He needs to nominate a new chair from within the existing set of Fed governors. He can't add anybody to the board. So, and the Fed operates by consensus anyway. So, okay, let's say you try to make Powell not the chairman. It's the same board. Powell is still on it. He just doesn't have the name tag in front of him. The upshot is the same. The relief here seems relatively clear. In fact, we know that the president can have bitter enemies that become dear, dear friends, and then bitter enemies, and they're dear, dear friends at the speed of tariff policy reversals or faster. And if Powell were only to see rates cut, which is something that he's trying to do already, even before this administration took office, the thing might be diffused yet. But I think the sort of the big picture here is, if you think the US dollar doesn't have an alternative, this is the situation where it still doesn't, ultimately. But the level of incremental pain and how much cheaper it can get before those kind of end of system breaks kick in, there's still so much room. The world still owns so many dollars. There are still so many dollars you could sell that the pain probably continues. Maybe not in a straight line, but let's say the president comes out and says, you know what, I'm going to let Powell serve out the rest of his term. I'm not going to fight that part of the process. The markets would unclench, the dollar would unclench. But the trajectory is ultimately toward a weaker dollar. I don't think it's toward a systemic unraveling, because frankly, nobody's invested in that kind of an outcome because there's nowhere else to go.
I don't know. Maybe they're all short the dollar. maybe people are invested. Yeah, but people do have to trade amongst themselves somehow. A non-dollar payments architecture that's comparable just doesn't exist. No, that is true. And even if you talk about stressing out like the Eurodollar system, which is a break, like, the offshore liquidity in the market, if that breaks, do you think people are going to hold the dollar side of the equation or the euro side of the equation longer term? It would be a massive script, right? And that would probably be actually one of the signs that things are getting worse in this here, right? Like all of a sudden bonds are down, stocks are down, gold's down, and then the dollar starts to surge. It's like, oh, this is a liquidity crisis.
This is getting Armageddon-ish.
Well, for now, gold continues to serve that role. Like if you have to allocate your incremental unit of currency somewhere in the system and you're not going to put it into the greenback right now, do you really feel comfortable holding it in fiat altogether if the system itself is going to be pressured? Probably not. Right. For today, that theory still holds. Dylan, 3425.30 in gold here. I have potential targets up near 3,500 right now in this particular technical run. Is this the biggest alarm bell in the world right now for traders, that gold is just up 30% year to date? Because
I've been talking, as you know, I've been doing these morning discussions with Rich McDonald in London, and we sort of talked ourselves into short gold, long dollar last week, which was a catastrophic set of decision making on our part. But I mean, it's hard to see how this isn't a price extreme. I mean, listen, the trade hasn't worked. Thank God I made it small. All those things, Or I mean, either this is a secular shift in the value of everything because of a new American economic regime, which it has the appearance that it could be that.
Yeah.
Thus, the prices being what they're doing with it, whether it's the term premium in the bond market. You've just listed all these prices. We know what's going on, gold, dollar, blah, blah. Or Trump is predictably unpredictable on the one hand, and on the other hand, predictable in that sense that he always backtracks when it comes to the last moment, he backtracks. But even if he's going to backtrack this, you can't backtrack the fact that uncertainty and wait and see has become the de facto standard for all engagement with American economics right now. So even if Trump's going to backtrack, the fact that this could even be introduced as a new way of thinking, anyway, it's a circular way of saying either it's a new paradigm for the value of everything. The dollar's worth much less, gold is worth much more. A big ass recession is coming, or buy dollars and sell gold and wait for Trump to flip it around. And I honestly don't know which one is correct. I'm not even sure how to calculate the risk probability on both of them.
Well, I think, Chris, what you were saying before about whether there is, in fact, a Trump put in the bond market, that basically becomes the bogey. You're back to those levels where that's supposed to kick in. After
Pretty
today,
dang close.
after today, the bond market is on the line. It's right there.
This is the low close post Liberation Day for ZB.
Yeah. This is the time. So we're what, at 4:30 Eastern almost? Some point in the evening today, there needs to be some kind of a tweet or something to unclench this.
I saw a great tweet earlier that's going to vibe with that sentiment as well. You know you're stuck holding a bag when you look at the monthly chart for support.
That's right.
When you're right. when the analysis is like, well, this thing needs a tweet. That's FUBAR.
Yeah. No, you should. That's right. That's right. But this is where we learn. Is there a put? Or is
I think that's the lesson this week, because the economic calendar itself, Dylan, is really, all things considered, fairly empty. Talking about a few days from the 24th, durable goods and existing home sales. Ilya, I know you're paying attention to the PMI readings over the coming few days. Those are going through tomorrow. Well, that's actually the 22nd. So 22nd is Australia. 23rd Wednesday, that's going to be the UK, Eurozone, US. How bad are these PMIs going to be?
The expectations. Can I make it a two-part question? Sure. How bad are they going to be? And also, at what part of any economic report is the relevant part right now, considering the inflection point in global economic policy?
The only stuff in any of this now that matters, in my mind, is what number does it take to get the Fed to be able to justify cutting maybe as soon as May. And if you can,
okay, all right, go ahead.
That's it. The president is aggravating a conflict with the Fed. The markets have been screaming, by the way, in agreement with the president, let's just be clear, that the Fed needs to cut. That the release valve to all of this is Fed rate cuts. And inflation expectations in the bond market have been cratering to tell the Fed what the market thinks of his worries that the tariffs will cause inflation. They agree with him, but they just don't think it'll matter because they'll cause inflation that will be so painful that demand will be destroyed in a recession to such an extent that the net impact will actually be disinflation because of economic weakness. And they're saying, look, you need to cut. So the question for the economic data is, do you get something that looks substantive? If you get a bad set of PMIs, you can reasonably conclude that the next set of hard data is going to be bad again. The numbers out of the Citigroup surprise studies that, Chris, you and I watch, they're deteriorating again. U.S. economic data getting increasingly worse relative to forecasts again after a little bit of a stalling out. So all the ingredients are there. If the PMIs are really bad, Fed officials, because they don't have to meet until May, they can start coming out and saying it could be the time. We may need to ease faster than we anticipated. But you need to see hard data. And the more the president tries to pin Powell into a corner, ironically, the more he's flirting with delaying rate cuts because the Fed doesn't want to look like it's being coerced. The Fed might well be more open to cutting in May were the president to have said nothing.
That is the most damning aspect of all this turn of behavior to me. Ilya, part one of my thought on this today was articulated during Futures Power Hour, right? Like Powell is gone by May 2026, no matter what. Now, there's certainly a cadence to how that works. If he's inappropriately, illegally fired and there's there's court cases and everything, maybe that just grinds out until, I think that would just grind out until May 26, right? So you just throw more and more uncertainty into a system here. But if the trade deals were really going well, why would you want Powell to start cutting rates right away? Right? You would, if the trade deals were here, if there was announcements about to be made, all of the president's time and attention would be focused on the trade deals and not demanding that there's a monetary policy offset from the fiscal drag that's occurring.
Right.
And it's an acknowledgement that there's no progress in the trade deals because the fiscal drag will continue to occur, and thus we need lower rates in Trump's eyes. So the Japanese delegation news this weekend, Dylan, I'm sure you saw it. Maybe if you didn't, and maybe others did not themselves. They returned back to Japan, immediately went into the local news. The video is out there with subtitles. You could read it in Japanese and translate it in your browser. They're basically like, you have no idea what the American delegation wants. They don't know how to articulate their position. So, Dylan, where's the off-ramp here? I know this is now becoming a situation where
I think that it's a fool's errand for us to sit around looking for off-ramps. I think the question is, either get out of the way of this entire thing, which has been basically my position as a trader, other than I'm holding my investment aspects. But from a trading standpoint, I've been out of the way. I foolishly moved in with my friend Rich McDonald last week on a short gold, long dollar, which worked as well as a fork in the eye. I think that, the only question I would have is from a trade. You're the momentum guy. Does your sort of default momentum position? Why not buy gold, buy Bitcoin, like sell the dollar? Just let it that Trump's going to stick to his guns. That if I take you at your word, which I have no reason not to, you're just reporting the news that there's that the dynamic in the trade negotiations is disorganized and inconclusive, and that this is going to keep going on for a while. So you better get out of your dollars, get into your gold, blah blah. Make your list, and it's a risk-off market, and it's a euro, long yen, long Canadian dollar. The only thing you have going against you, the only thing going, all those things, just do it. The only thing you have going against you is, on any given moment, the president can be like, oh, now's a good time to buy.
Any given moment, all the positions that are doing well for me could turn on their head.
Every single one could be plastered by 10% the other way because of one whimsical comment, which is no way to live, sir.
Are you sure?
I'm not sure.
Are you sure? Are you sure? The momentum's really ugly. We never really could get back to that 1 month moving average, the yellow squiggly line on our chart here. When we bounced back into it, never quite got through 19,250. Same thing for the S&P 500. Hard to believe that was 320 points ago last week, Elio, when we were talking about needing to get through 5,500 to really feel good about things. Now we're heading back down to the bottom side of the range. It could still just be a triangle that's coming together here off the lows, which just means a lot more chop. And I think that's probably the prudent path forward because, Dylan, as you point out, it's no way to live having to hang on to these tweets. But if there's ever a time for it right now, we see a Trump administration that has shown some sensitivity around a 10-year yield that gets to about 4.5% or a 30-year yield that gets to about 5%. And we're sitting on the precipice of that once more right now. So you see another spook in Asian hours tonight. It's very possible that we wake up tomorrow and it's a different world again because they announce some sort of, reframing so that Trump can save face and declare some sort of victory. Because obviously this effort to keep yields pinning lower is not working. Dylan, you weren't on last call, but I'll say it one more time for the folks that weren't there either. One of the more astounding features of this market, talking about how people just aren't buying America. America's still on sale. Bloomberg today, their ETF flows guy, Eric Balchunas, reported, you look at flows incrementally, for example, coming out of Europe in 2024, 50 cents of every dollar that was invested into the global markets coming out of Europe, 50 cents of that went into the U.S. In 2025 thus far,
what is it?
3 cents
I believe
of every
it.
dollar.
I believe it. I believe it. I mean, I would have guessed much more than that. I'm actually, I'm shocked that it's that absolute of a maneuver, but I'm not surprised. I'm not actually surprised. I would have thought it would have gone from 50 cents to 25 cents. It went to 3 cents, huh? There's just no reason.
Really extreme.
You're sitting in your Milan, where I am, or you're sitting in Paris, or you're sitting in Frankfurt, or Munich, or London, or Barcelona, or Berlin, or Vienna, and there's 450 million people in Europe. There's more Europeans than there are. It's just that Europe's just disorganized and fractious in language. I mean, there's lots of structural challenges that make it inefficient, much more inefficient than America, but it's still more human beings, and it's still massive piles of money. It just has more concentration of wealth than even the United States, because it has these legacy families that own everything. They've been given every reason not to put money in America. Basically, America. They sent J.D. Vance a couple of months ago and told America told Europe to screw off, basically, and then they followed through with all these actions. The only question is, can America be made to work for, let's assume that basically anybody with money is an enemy of Donald Trump, whether it's an American with money or a foreigner with money, and Donald Trump works for the impoverished and lower middle class Americans who were left behind in the NAFTA transition in the 70s, 80s, and 90s. And that the idea is to basically reduce global wealth and redistribute wealth to his voters at the expense of everybody else. I believe that's his plan. I think the outcome is going to be less money for everybody, including his voters. But
yeah, it's going to be a shrinking pie, to be clear. It's not like the market is measuring all future income, all future cash flows. And it's saying that the value of the pie is worth much less moving forward. And that's not to say that the pie, and I retweeted this over the weekend from Mark Dow, the pie grew over the last 30 and 40 years, right? You look at per capita GDP, you look at, you chained it in like $1990, the percentage of Americans that are making more than $100,000 a year in $1990. So backtracking it for inflation, more people than ever. Right. So we are a wealthier society on a per capita basis over the past several decades. There's two problems with that, of course. One is that the luxuries in life seemingly are cheaper and more accessible than ever. You want to get a new phone, you want to get a nice car, fine. But the necessities have just absolutely skyrocketed too. So like you want to get a new house, you want to go afford college. You're not going to hear the stories.
You looking for a fried egg?
You're looking for a single fried egg?
You're looking for a fried egg? Yeah.
Right.
But cost you, buddy.
Like back, you see the ratios. If I were to work at the minimum wage, how many hours would I have to work per month in order to pay the average level of rent in my area? That's been blown out over the past 30 or 40 years. It's outrageous. So that's one of the problems. But it's the trickle down, right? There's a great piece of data. I'm going to show the visual later on once I pull it up after I get off my little soapbox here. But what's happened since the first Trump tax cuts, the number of people who are worth more than $10 billion in America has increased by tenfold since the Trump tax cuts, right? And that wasn't the pace of wealth growth over time. And Dylan, you actually mentioned something that I do need a fact check here. Since 2018, the U.S.'s Gini coefficient has risen to exceed the broader European Union's average, the Gini coefficient being a measure of income inequality. So the pie's growing.
You're saying that
it's not being shared.
Inequality is worse or is more intense in the U.S. than it is in Europe.
At writ large now. It wasn't in the late 2010s. It has since flipped.
The transition to the United States being the most concentrated.
That the pie is growing. It's just not being shared by enough people.
Which is the source of Trump's power, and for that matter, Bernie Sanders' power, by the way, on the other side of the ledger. And it goes back to to repeat the circularity of our discussion, but whether it's Bernie or Trump correctly identifying the problem, or people like us. No one's debating it. We got it. I got it. but the solutions the solutions, in my opinion, sorry, Ilya, are never getting properly debated in a way that actually results in yielding some system of adjustments. Instead, it is either it's these extreme declarations from the far left of, tax the rich and whatever it is, which is obviously tax increases on certain economic classes have foundations for, I believe that they're a good idea personally. But the point is the way that all these policies, whether they're far left or certainly this situation, none of them are well vetted or have any apparent trajectory for success, and all of them are ultimately self-destructive. I mean, I really think we are living through the super large scale exhibition of Harvard's ultimatum game. We're in a behavioral economic experiment where people are doing what is against their personal self-interest because they would rather see everyone else suffer than to be left in such a disproportionate position relative to the wealth as it's created. And that's the basis of the ultimatum game, is I would rather have nothing and have you get nothing than to have you get a lot and me get a little.
And if ever there was a sort of microcosm way to see this exact thing in markets, it is, of course, that so much market cap has been baked into a handful of names on the NASDAQ. Because if you ever wanted to see why the Gini coefficient is showing what it's showing, we'll just consider who owns most of that most equity market value in recent years has gone to that one pocket. And if you consider that people's wealth is in part being measured by financial assets, which, yes, are subject to market risk, but not that much market risk until recently in practice, then you see how you get that disparity. Yes, it's paper wealth disparity to a large extent, but that doesn't change its political implications.
No, it doesn't. We have a day where, broadly speaking, the markets are down across the board. Even some Bitcoin-related stocks can't get a bid like Marathon Holdings. Dylan, the implications of Bitcoin performing well in this environment, if Powell is going to be fired, obviously the market hasn't priced that at 100%. We have to wait on some Supreme Court decisions. But it feels like we're, getting to a real breaking point here for a lot of different things.
No, I agree with you. I wonder where the Republican Party is right now. I mean, there's sort of two, the bond market and the Republican Party. Because those are the only two actual practical forces that exist right now that could tap the brakes on this whole thing. The bond market tapped the brakes that one time a couple weeks ago.
Yeah. There was an interesting quote, and
I haven't seen any Republican
here.
Brake tapping. Sorry, go ahead.
I'll pull it up here. It's from Senator Kennedy of Louisiana, who's a very kind of hardcore right-wing Republican to the sort of farther side. And the exact quote, I want to make sure I read this verbatim because it's such a good quote. He said, "My experience with Jay Powell is that he's got tiger blood. He's going to do what he thinks is right, and he's not going to go down in history as the Federal Reserve Chair that allowed inflation to become wild as a March hare. He's going to do what he thinks he's got to do." Maybe this is some kind of a sign of something.
What are you suggesting? You're suggesting that the Republicans are going to try to hide behind Powell as a way to, so that they don't attract so much inbound from the Trump administration?
I think they're going to try to defend Fed independence because I think even for them, this is a bridge too far.
It's just...
And then basically hope the bond market and the Federal Reserve...
And if that were to happen, the bond... Well, consider how silly it was that the market found any kind of reprieve in this pause
in retrospect. It's
in the reciprocal tariffs. I mean,
the 9% update.
I mean,
in fairness,
we were saying
had that
this at the time.
And we said the math just doesn't check out, and like this is something difficult to really like.
We said
like,
on the day of.
Like
we
the announcement itself is exciting,
right?
and the second you look at the trade weighted data, it's like, hold on, this brings the effective tariff rate from 27 to 24. Okay, so this is still a tenfold.
Right, but it made me reflect on it. I'm sorry, I'm talking over you guys, but like, did the bond market even tap the brakes?
It sort of paused the bleeding, kinda.
Did it? I mean, it delayed.
Kinda.
I mean,
but only kinda.
Yeah.
But only kinda.
I mean, it bought a week.
It bought a week. And of course it only bought a week. We said this at the time. What has the president done? He's injected more uncertainty into the tariff rollout. What has been the problem with the tariff rollout? The uncertainty.
He won the Mar-a-Lago Golf Championship.
He did.
Mm-hmm.
Who did?
He did.
Trump.
Oh, doesn't he win every year?
He has.
Well, it's the Mar-a-Lago Championship.
Every day?
That's how this works.
Mm-hmm. Mm-hmm.
Yeah, I mean, it's... We said this at the time. We said, oh, wow, look at this stocks rally. This is not going to hold.
But here's the other side of the... I'm just thinking out loud, but this whole time, the market is fundamentally, obviously, adjusted. Lower equity prices, higher gold, bond, dollar. We've talked this ad nauseum. However, the magnitude of the price changes has not been nearly as big as it would be were all of these tariffs to actually be implemented. There's always been a constant discounting of the fact that whatever happens, something's going to happen. Uncertainty is the rule of the day. Wait and see is the attitude of the day. But whatever happens, it's not going to be nearly as bad as what's being talked about right now because Trump always makes there's always some sort of a something.
Right.
And that's why the bond market isn't really tapping the brakes. The bond market is saying, you know what, there's no way it's going to be that bad.
I mean, you have to figure that as bonds are falling back, there are people who are looking at it and saying, yeah, but I can get 4.5% on the 10-year, lock it in right now. I'm happy to hold that. I can hold that. I don't think the U.S. is going to default on its debt in the next 10 years, right?
Well, yeah, maybe, but it's being taken out in the currency. That's my issue with the whole bond thing is the bond market may not be doing much work, but the currency market sure as hell is.
Well, yes. That's the whole thing, yeah.
And this is an interesting chart from Robin Brooks, who's done a number of things on the government, non-governmental level in the world of macro. He talks a lot about currency. So if you're interested in like the mechanics of the currency market and capital flow, him and Brad Setzer are the two folks you got to follow on Twitter. He here had a tweet earlier that's outlining the paths of the 2018 versus 2025 tariff impact. You could see how stocks, the blue line in 2025, are already underperforming the way stocks behaved at the onset of the 2018 trade war. Although somewhat fascinating, you could see from the start of January 2018 until about April, that's when the pain really comes in. And we're kind of at the same calendar point where Trump started to change his messaging back then a little bit. You see here with the dollar is getting crushed. G10 or G10FX are soaring versus the greenback right now. But again, when did we see the turn in Trump's tone? It's April, May of 2018. So the 4.5% on the 10s, 5% on the 30s. Crazy news stories from the Japanese trade delegation. Americans don't even know what they want. Okay, so we're all being pretty doom and gloom here about the state of things, and obviously this can change in a second. And as traders, right, I want to remind everyone, as traders, you have to reserve the right to change your mind. If tonight Trump tweets that he's backing off and they're opening up, they're going to do everything through the WTO, as corrupt of an institution it may be, because they've helped China launder cheap goods to the rest of the world, yada yada. The market unclenches. There's at least a temporary multi-year downgrade to U.S. credibility, trustworthiness as a counterparty. It's not going to resume capital flows directly into the U.S., but trade isn't going to fall apart, so you're going to see a nice relief rally. It's a nice story to tell ourselves.
Yeah,
I think the key here is like approaching this mechanically as a trader. You just got to make sure you're staying small. I much prefer right now to operate in futures that are liquid as opposed to the ETF equivalents, because Trump tends to tweet later in the day. There are a myriad studies on the distribution of when Donald Trump or the White House releases remarks. It seems to be clustered after 1 p.m. and then a lot in the evening. So if you're going to be trading in these markets, having access to a vehicle that allows you to move in and out, I think is prudent. It doesn't need to be ES. It could be MES. It doesn't need to be the futures themselves. It could be the options on the futures. Although if you're trading overnight, MES is much more liquid than trying to get in out of a call spread where liquidity could be thinner, depending upon the expiration you're looking at. But if you're going to be trading these markets, you need to have a plan and have alerts set so that when things happen, you know how to respond. I suppose in terms of positioning for tomorrow, I'm going to keep on the long yen. I'm going to keep on long gold. Unfortunately, getting kicked in the teeth with this ongoing attempt at a short put spread exposure, just hoping for theta burn in ES, which is not working out well. The short iron condor trade in ZN is fine because the thing continues to chop around. The short put spread in ZB is suffering, but it's not dead yet. Some of my utility stuff came back in a little bit today, although, again, long the 42, short the 47 call spread here, so there's plenty of time on the board. I don't see a reason to change anything, but I find the gold Bitcoin outperformance over the NASDAQ today, when bonds and dollar melting down, to be one of the clearer signs that we're heading into a world that just is, we need an off-ramp where things are about to get potentially a lot more difficult in a real way.
One thing I suppose you can hang your hat on is the president's job approval ratings from an average of polls that I look at from Real Clear Politics is crumbling. And we know the president doesn't like that. We know he's attentive to these types of things. Now, of course, he doesn't have to run for re-election unless he does want to entertain some of the kookier ideas that have surfaced out there about finding a extra constitutional way of doing that. I know Steve Bannon has been out there saying that a lot to any media outlet that would listen. But presuming that norm holds, the president ought not care necessarily about this, but he certainly does seem to care generally and constitutionally about sort of his party being able to ride his coattails and him being able to say, I delivered, you're all getting all this political support because of me. And so maybe with the bond market at its pain point, popularity falling, and internal Republican grumbling mounting, maybe there is, in fact, a release valve here. But what a trading strategy it is to consider looking at risk allocation around those kinds of catalysts.
Dylan, give us something positive to talk about here. Today was obviously a very big news day. Of course, Pope Francis died. I find it incredibly interesting that as America goes through its own Brexit moment from global trade, similar to how right after Liz Truss met the Queen and the Queen died, right after J.D. Vance meets the Pope dies. What's the view from Italy? How big of an event is this? Is this something that's going to impact the European economy in any way whatsoever? Italy's role?
I'm going to separate the passing of the Pope from everything else, because I think that, so let me set that up. I'll save we have 5 minutes. So I'll give you a minute on that at the very end here. The optimistic statement I'll make is this: Donald Trump always backtracks, always retracts, always changes path. There's a reason that the bond market, I know things are looking grim, but things looking grim is part of the routine. It's like producing a reality television show, except for the reality television show is global economic expectations. And so I would say that the most optimistic thing I could say is, you're not dealing with a Powell or even a John Roberts or somebody with a history of sort of very mature, very resolute, very unwavering character who deeply considers decision making, and then once the decision is made, follows through with that decision. You're dealing with someone who's intensely impulsive, fickle, and changes their point of view on a daily basis. And there's a reason that the bond market is not tapping the brakes yet in the way that it could or it might on a Liz Truss, for instance. And it's because there is still an underlying expectation that whatever happens with Trump, it'll cause a slowdown, it's causing uncertainty, it's causing wait and see, but it's not going to cause the full cratering that that full implementation of what's being discussed would imply. So I'd say that the most optimistic thing I could say is the wild policies that you're seeing are being prosecuted by someone who has zero credibility when it comes to follow through on things like this. Regarding the passing of the Pope, there is no economic consequence of the passing of the Pope. There is a spiritual consequence, there is a cultural consequence, there is a religious consequence, there's a consequence in Italy. This was a revolutionary individual, this Pope, in terms of the doors that he opened and the manner in which he opened the church to people in a way that no previous Pope ever had. That personally, I think, was a really beautiful thing. And there are two prevailing lines of thought in Rome right now, from discussions with people that are in direct contact with the cardinals and it's a whole world, right? The conclave and the smoke and all this. There's one school of thought, which is that this Pope has opened up a path towards liberalization in the Catholic Church that shall never be closed. That it cannot be closed. That generationally and culturally, that this is the future of the Catholic Church. There's another school of thought, which is that it's like that the papacy is much like global politics, where when you have a liberal leader, then you're going to get a conservative leader, and you're going to get this sort of backlash with a more conservative leadership in the Catholic Church. Personally, I believe that both are likely. I think there will be a more conservative leadership that is brought in as the new Pope, as will be my guess, and that it won't matter. I think that it will continue to be on the path of Pope Francis, even if there is not a Pope Francis II who is brought in. It is not economically relevant, but I believe it is morally relevant, especially because this Pope was such a great advocate for the global South, which is all of South America, all of Africa, by far the most abused aspects, or the most abused communities, nations, by the global economic system. And I'm hopeful that there is an advocate for those communities that finds his way to the Vatican once again very soon.
With that, Overtime is out of time for this Monday, April 21st, 2025. We'll be back tomorrow, same time, same place, 4 p.m. Eastern, 3 Central, right after Last Call. So for Dylan Radigan in Milan, Ilya Spivak in San Francisco, I've been Chris Vecchio in New York. We'll see everyone again soon. After a brief break, more Tasty Live coming at you. Ilya Spivak up next with Macro Money.
See you there, everybody.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Decision to build Thinkorswim was a byproduct or derivative of 20 years. In our minds, the future of finance meant that we were going to move away from something that was very manual and move to something that was tech-driven.
What we did with Thinkorswim truly changed the industry. To do it a second time was a challenge that I just had to take. The platform is just leaner, cleaner, a little meaner, legitimately built from scratch.
Your crypto needs a wallet, and crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market. Dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Oh, the bloodletting has resumed. Took a little bit of a break last week on a shortened Easter holiday run in the markets. But as we begin this week back from that holiday, the risk-off train is steaming forth. This is Macro Money. I'm Ilias Pivak, head of Global Macro here at Tasty Live. And we're going to take a look at what might be animating these markets in the week ahead as the pain has seemingly returned. We see the markets once again under heavy pressure on a thin holiday held back Easter Monday, because of course in the U.S. markets were open, but in Europe we have closures pretty much all around the major exchanges. Hong Kong is closed, Australia, New Zealand. So very, very thin liquidity and not a lot of conviction perhaps behind today's moves, but nevertheless a brutal tone to all of it, and for understandable reasons. We'll unpick those here momentarily, but first, let's get an anchor here in the price action that played out last week. We can see stocks back under pressure. S&P 500 down 1.5%, NASDAQ down 2.3%. That's after those blistering gains in the prior week, and in fact, those jumps there, 5.5% for the S&P, 7.2 for the NASDAQ. Those were modest versions of just how strong the prior week's rally really looked, and we'll take a look at it in just a second. But back to selling last week following those gains, and although looking just at the percentage changes here, it looks like, oh, well, we had massive rallies and then a bit of a correction, nothing to worry about. Well, it doesn't quite stack up that way when we look at the price action. Similarly, for the bond market, we had massive, massive surges in yields last 2 weeks, and the very last week, a little bit of a pullback on that. Bond markets cratering and then somewhat steadying last week after that aggressive move. And the sort of consistency in all of this still being found in gold, which posts yet another week on the upside, 2.6% after a 6.9% gain, and the dollar keeps selling off, perhaps in a parallel fashion, down another 0.5% against the euro, 0.9% against the yen. Bitcoin starting to benefit from the relentlessness of dollar selling, up 1.2%, despite the defensive tone and overall risk sentiment, as is very clearly epitomized here by the stock market. And so we have something like a pause of sorts last week, at least for the core markets. The dollar keeps limping down, gold keeps clawing its way higher, but crude oil is up as a kind of measure of cyclicality and recession risk. Yields unclench a bit, and although stocks come down, they come down after what are massive rallies, and so perhaps things aren't quite so bad. Well, not so fast, because the pain has resumed in earnest this week. Here's the S&P 500 right here, and we can see just what that massive rally was. It was a single day off 15-month lows here. Just one day where we had an announcement, 11th hour announcement to boot, from the Trump administration, the president putting out a post via his Truth Social social media platform saying that the reciprocal tariffs that he'd announced on so-called Liberation Day, when he unveiled bilateral tariff rates across most major U.S. trading partners, and in fact, almost all countries that the U.S. does business with, from Belgium to Botswana, as it were, and said that the new baseline tariff of 10% would hold, but everything above that would get put on pause for 90 days, except for China, which would not get a pause, and that this pause would give some space for perhaps the start of negotiations and some kind of a reprieve. And while the average U.S. tariff before the new minimum 10 was closer to 2, we still have a 5-fold increase in U.S. tariffs any which way you look at it. The markets looked at the episode and said, okay, we have a bit of a reprieve, a bit of a response to market discipline, because, of course, going into that announcement, that sort of softening of the on-ramp, the markets were in near free fall. So, okay, this is a little bit better. We can perhaps unclench a bit. And that lasted for all of one day. It was an explosive one day, but only one day. And of course, now we have almost fully erased that move as we get back on the defensive today. Now, the reason it lasted only one day seems pretty straightforward, and we discussed it when it occurred, essentially the day of, and put forward the idea that if the sell-off initially from about mid-February, late February, is a reflection not of the idea that there are tariffs, because that much was known back in November, and clearly no vicious sell-off materialized then. If that's not the reason, then what is? Well, it's the turn in U.S. economic data and the signs that the implementation of the tariffs is creating a situation where now you have a sense that business confidence and consumer confidence have been negatively impacted by how things are occurring, that this has put the brakes on economic activity, and that what is then following is a hit to growth, not so much because there is a tariff regime, but because of what the tariff regime is and how it is being put in place. That consumers and businesses are withholding money that they would have otherwise spent or invested around uncertainty, and that what this is doing is it's hitting the economy and creating a growth scare. And this is what the concern is. Well, if it's uncertainty that's the issue, then rolling out a schedule of tariffs and then days later pausing some of them for 90 days creates yet another cliffhanger and creates more uncertainty, which of course doesn't resolve the issue but compounds it. And so after this one-day relief jump, the markets hit a wall, tellingly at former support become resistance, and settle into an easy range until the latest offense hits the tape and the markets have the chance to show their displeasure, with the president taking pot shots at Fed Chair Jerome Powell, saying his termination cannot come soon enough, bemoaning after last week's ECB rate cut that the Fed is not following suit and isn't cutting interest rates. That, of course, has spooked the markets, because one of the bastions of U.S. economic credibility is the independence of Federal Reserve monetary policy making. And if the president is dictating what interest rates ought to be and what the central bank ought to do, and threatening an extrajudicial firing of the central bank head, who himself has asserted time and again that such a firing would be illegal and would be fought in court, that more uncertainty has entered into the picture. Whatever you might think of the president's opinion on interest rates, the Fed's resistance, the rules that govern the Fed's independence, whatever might be one's opinion of those things being right, wrong, or what have you, they have been a system that has served and served well, and the markets now see a threat to that architecture, and that, of course, makes for more uncertainty. And that uncertainty, not surprisingly, has once again taken stocks lower. We have essentially started the return back in the direction of the lows from the beginning of the month. The pain is even more acute in the bond market, and this is now a weekly chart just to show a little bit more the overall state of things and just how critical of an inflection point we're at. Bonds stabilized a tad last week. That's after that massive sell-off that we mentioned that gave that surge in yield that we showed earlier. This was that right here. And now with this attack on the Fed, bonds are right back to those lows. They're right back to where they closed on that brutal week where the situation looked so dire. And so the question now, of course, becomes, are we essentially back at the brink? Was last week just the short pause in the process, and now the intensity of the sell-off is ready to reconstitute and the panic to move forward? Now, this perhaps is nowhere captured better than the bond market, because what the market seemed to have concluded when the president rolled out this reprieve, such as it was, on reciprocal tariffs, was that the bond market had gotten to some kind of a pain point. That what the president wants, this is ostensibly why he's berating Jerome Powell, is lower interest rates to smooth the on-ramp of all of his new policies, which would be, not surprisingly, more digestible, were money cheaper. Now, what we have as a result of these efforts is money that's more expensive. When you have this massive decline in bonds, that the flip side of that, of course, is a surge in yields. Again, that same decline in bonds corresponded with a 12.4% jump in the 10-year rate, 9.1% jump in the 2-year rate. So why is it that the actions being taken here and the uncertainty that we see in the stock market, why aren't bonds going up with that? Are they not a safe haven? Is that not what you typically see? And of course, breaking this down into the constituent components is what it takes to see exactly what's occurring. Now, in the brown here, what you have is the term premium that's embedded in 10-year nominal yields. So when we say, oh, the 10-year yield, you can break that 10-year yield out into components. One component is term premium, which is compensation for uncertainty risk. That is the passage of time. If you think more can go wrong over the allotted time, let's say this is a 10-year rate, so if all of a sudden you think more can go wrong in that 10 years than you did before, well then you're going to demand as a lender to be compensated more for that time, for that additional risk. And we can see that risk is surging. At the same time, the break-even inflation component of the bond yield, that is inflation expectations reflected in the treasury market, that's falling. As if to say, yes, we do need rate cuts because all of this consternation and all of this uncertainty is going to bring on a recession that's going to be deep enough that whatever one-off hit that the tariffs engineer that pushes inflation higher is going to be offset because demand is going to be so hurt by these policies and the recession so deep that the net result for inflation will actually be lower. That what you get in terms of inflationary pressure from basically increasing consumption taxes, sales taxes, as it were, on imports in a drastic way, that will be offset for the aggregate inflation rate for the country, because demand for everything will drop out of the bottom. And so this is how you end up with bond yields surging. So the upshot is that the result of all of these things has been precisely, taking the president at his word, what he doesn't want, which is to say higher borrowing costs. Now, the markets have, of course, reasoned that if a deep recession is in fact coming, then the Fed will in fact have to cut more. And we have seen that develop here over the recent weeks. As we've had stocks come off, so too the markets have baked in more easing. But we can see that the resistance from Chair Powell recently really does show up here in Fed funds futures. There hasn't been a whole lot of movement on this. We're sitting at about 115 basis points being priced in for the year. The markets in that are not so far off the Fed's own forecasting. This was the March update of the Summary of Economic Projections, where the Fed said from a base of 4.4% center line on rates, we're coming down to 3.9% this year, 3.4% next year. This is 50 basis points in cuts. This is another 50 basis points. That is to say, 100 basis points or 1% in cuts through the end of 2026. The markets are only 15 basis points more than that, so about 50-50 on a fifth cut. That's not that far off considering all of the consternation. The markets think that the cuts need to be a little bit more urgent, so they see maybe closer to 3 erring on 4 this year, maybe another one next year. But sum total, we're not so far away, a little bit more dovish than the Fed, but not so far away as to explain what's going on in bonds. And the timeline for those cuts looks very much like the Fed is going to delay until mid-year. Looking now, a full 25 basis point rate cut doesn't really get discounted until July. And then from there, we start to see more sizable consecutive hits, and the outlook starts getting a lot more dovish. Now, this is where the release valve on this consternation may very well find itself this week. There's not a whole lot of macro data on the calendar, but we do know the Fed wants to cut, and we do know the market would perhaps welcome some dovish squawking from the Fed. It certainly seems to say that the Fed has clearance to cut in what it's showing in its assessment of inflation expectations. And if the Fed were to start to talk as though it might be likelier to cut sooner, well, then perhaps some of the pressure from the White House would ease and the situation might be unwound. How likely that's to happen hinges on a couple of things this week in terms of what the markets will look for. The first will be an update of economic projections from the International Monetary Fund. The annual meetings of the fund and the World Bank are happening in Washington, D.C. at the moment. So we can see here that this is the last update from January, and the expectation is very steady from 3.2% global growth in 2024 to 3.3% the subsequent years. The advanced economies going up from 1.7 to 1.9 this year, then cooling somewhat. Very modest. The U.S. outlook, it's toward slowdown, but not a significant one, down to 2.1% in 2026, which is still quite fast by U.S. standards. China seen continuing to slow from 4.8 to 4.6 to 4.5%, but again, nothing catastrophic. But of course, this is January. So the markets will be very interested to see to what extent this is now slashed, given what's occurred and how the outlook has changed. and just how much red ink appears on this when these numbers are updated tomorrow. Next will be the set of flash PMI numbers from S&P Global. This will be April data, and this was the beginnings of where the market started to worry about the rollout of these tariffs and other elements of the Trump administration's fiscal policy and the impact on growth. This is where the markets really got concerned. The PMI data in late February the 21st, if memory serves, is the first kind of batch that really gets things going. This is where those concerns arise. So watching how this develops going forward will be very interesting because, of course, if you do see a very significant drop-off in the PMIs, wouldn't be a stretch to then look ahead and say, we are going to likely see this show up in the hard data that the Fed needs to see, but perhaps it will be enough to get the Fed at least talking about becoming more dovish. And then the hard data would validate and they could get to cutting and get to walk away from this headbutting with the White House. The expectations seem to suggest that indeed a meaningful slowdown is probably on the cards. Manufacturing seems getting back into contraction mode for the U.S. as ever. These things are in a logic centered around 50, where that's neutral. Above it is growth. Below it is contraction. The faster you go, the further you go above 50, that is, the faster the growth. The further you go below 50, the faster the contraction. So this 49.4 here on manufacturing in the forecast, that speaks to contracting manufacturing in April being the baseline, and a significant slowdown in services from 54 to sub 53 expected. The numbers out of Europe don't look all that great either. The composite expected to slow there. For the UK, the same thing, back to standstill on growth there. In Japan, contraction. In Australia, contraction. So the story looks to be that of negativity. And of course, that shouldn't be much of a surprise looking at the Atlanta Fed GDP Now model just as a barometer of where the data is going. Never mind the actual levels, whether the economy shrinks something like 1% or maybe just doesn't grow, or whether it shrinks between 2 to 3%, depending on the model here. That's less relevant than the trajectory of where things are going. And clearly they are going down. And that's the key takeaway. The data that's incoming daily to populate this model is very clearly pointing lower. In fact, Citigroup's Economic Surprise Index for the world is telling us that the generalized story here from March into April for global economic news flow is to increasingly start to deteriorate relative to forecasts. So if we get very negative results and perhaps the Fed then starts to sound more dovish, then maybe we get a little bit of an off-ramp here, and stocks can steady and bonds can steady a bit, and perhaps even the dollar can start to come off its lows. But it is a delicate dance, and we would be hoping that the data is bad enough that the Fed relents, which is hardly something encouraging for the economy or for risk sentiment longer term. The last bit the markets can perhaps surmise is maybe there will be another policy reversal via midnight Truth Social update, and that might happen, of course, because the president seems to be increasingly unpopular. The polling here from Real Clear Politics, an average, telling us that the gap between approve and disapprove is widening increasingly to disapproval territory by about 3.6 points, it looks like, on average. And perhaps that is a forcing function for yet another reprieve of sorts. But without that, the architecture here seems to be, if only we could just get the Fed to cut with enough evidence of a deep enough recession, then maybe sentiment can unclench, but for how long? If the reciprocal tariffs example holds, then maybe we get a violent rally, but whether it holds or not is another story altogether. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am back with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Move with the rhythm, shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
So you're an active trader, looking to increase your return, decrease your risk, or quite possibly both. Sure, you've heard of the Greeks. You know, your deltas, your thetas, your vegas, your charms, your vamas, etc. And you're wondering, hey, how do I use these guys to improve my risk-return relationship? Well, join me for a 10-episode crash course, and I'll show you exactly how to do it with all the gimmies and gotchas, one Greek at a time. We'll see you there.
All right, we're back. Tasty Crypto Show. I'm Ryan Grayson. With me today, of course, the one, the only, Katie McGarrigle. The wizard, the ninja, the Viking. What's new?
Nothing. I'm off the sauce right now. I finished my Viking arc.
Okay.
I have not entered the ninja arc yet. I might
Thinking
return
about
to
it?
the Jedi arc. I'm thinking about it. I need to read a book though. Like I need to step away from the games, the little controller, read a book,
Okay.
maybe watch a show. Last of Us just came back.
It's a video game show, though.
That is true. So yeah, is that a cheat? Is that fair to say?
We'll give you this one.
Thanks. Yeah, but I'm pretty good. How are you doing?
I can't complain. We had an extra day off on Friday for Good Friday. Decent weekend. I went car shopping, Katie.
Ooh.
Yeah.
Nice. What you looking at? A SUV?
Honda CRV.
Okay.
Yes. So I guess that's a SUV.
Yeah.
Yeah.
Not a SUV, not to be confused with a SUV.
No, but a compact
Yeah.
SUV.
Nice. Okay.
Yeah.
You get going murdered out. We go on black rims, black
Obviously.
tinted windows,
Yes.
black everything.
Obviously.
Yes.
Yeah.
All right. I'm here for it.
Yeah, it's about time. I got to get some wheels. So my wife and I are in that process. But yeah, weekend was good. Appreciate you asking. How was your weekend?
Pretty good. No complaints. You know, try to catch up on sleep. Trying to digest everything that the market continues to do. But yeah, nothing really big went on in my universe.
Okay. Well,
Fine.
that is
We
sometimes
need it.
the best.
Yeah. I'm traveling this coming weekend. So
Ooh.
yeah. So
Where will your travels take you?
I'm going to Napa with some gal pals.
Okay.
But the problem is I have not drank since New Year's. So I'm a little scared that I'm out of my depth.
Good luck.
Thank you. It's going to have to be little flight of wine, big glass of water. Little flight of wine, big glass of water.
Sure.
'Cause I don't want to get caught in, I don't want to get too lost in the sauce, as the kids are saying.
Big ass goblet of wine.
Yeah. I mean, that sounds delicious. Don't get me wrong. I love a glass of red wine. But I know that taking some time off from consuming it probably, it's not going to do me any favors if I just go off the deep end.
Well, you're going to have to start training ahead of the trip.
Yeah, why don't I mean,
show
can-
gets
can
done at
somebody
5
get
o'clock
me
here
some
tonight,
wine to
right?
replace this sparkling water that I have?
Well, I hope you have a safe trip and hopefully you can hold it together out there
Thank you.
in Napa Valley.
Thank you. If I send you the SOS text message, just ping the satellite and find my location, and I'll expect you to roll up and
We'll send the
maybe-
chopper.
Yeah, exactly.
I'm looking at the chat, Katie. Jose says Katie is the GOAT. What's up to the few of you in the chat? If you're not streaming this on YouTube, get your ass over to the Tasty Live YouTube. Pop open that chat, get the top chat, the live chat, sign in, whatever you got to do, and type some crazy shit in the chat. Per usual, Flower Power, what up? Rezo, am I saying that correctly? Probably not.
so.
Okay, maybe. What up, Lone Sophos? How you guys doing? What do you want to talk about today, Katie? You want to talk crypto? You want to talk the markets just dumping on us here, except for crypto?
Yeah. Bitcoin up, what, 2.5 or so?
Yeah.
ETH.
We flirted
Pretty
with
unched.
88 today. I mean, Ethereum's never going up again, obviously. But Solana looking a little bit better. We've got some bullish signals here or there.
Okay.
Got some slides to talk through, but yeah,
There was a couple
go
more
anywhere.
coins added as well, like late last week. Am I wrong?
Let me double check over here on the crypto platform, which is Tasty Trade. We did add, or I know we're in the process of adding Ethereum Classic, so that's there, ETC, and then Compound is on there as well.
What is Ethereum Classic?
I believe this is Ethereum prior to the hard fork way back in the day.
Okay.
I'm not quite sure that many people are trading this, to be honest with you, but
got it.
as I understand it, that's the token. Yeah, we're going to continue to add more product here. We've got a few more coming soon, including Polygon. So hopefully another 4 or 5 in the next week or so.
That's awesome. That's great. Yeah, no, I mean, I'm open to discussing kind of whatever you want. Like you said, maybe a little bit, I don't know. I mean, I'm personally having a tough time with my gold position, as I think many people are that are on the short side of things. But I'd kind of love to hear your take about knowing that we did have a long weekend and all that kind of stuff, how you felt like crypto markets reacted. Did it feel like a quieter weekend? Like, what are you kind of thinking about? I guess another question that I have that kind of comes up a lot of times too, particularly in the stock market, is like, and especially because we're coming up on that month, is like the whole idea of like sell in May and go away. Even though I know tastylive has done some research around the merit of that statement, I guess, if you will, but like, do you tend to see any seasonality as it pertains to the crypto space, or because it's kind of like an always on product, it's all up for grabs, every day is different, there's not really a seasonal element to it?
There absolutely is a seasonal component that you can observe in crypto. I don't have it off the top of my head here, but I might be able to pull up some slides in the meantime. I'll poke around and see if I can find the research that we put together. This would have been almost a year ago. Well, not quite a year ago. This one is from 2023. Apologies. So
it's okay.
Well over a year ago. But let me see if I can pull it up.
Months ago or so.
But yeah. I mean, we updated this study, so there is certainly a seasonal component to it. At times, we've seen a lot better performance in October, November, in the fall. You have seen quiet periods during the summer as well, though hard to argue that it's as pervasive just given there's a lot less data, right? It hasn't been along or around for that long. So maybe not the same way that you would look at it in equities, but there's certainly, some seasonality to it. Just let me see if I can find this here.
Oh, good. Yeah, and I didn't mean to throw a wrench in your plans, but yeah, I mean, as we've kind of talked about, I have a little bit in my personal account. I have a little bit of Solana, a little bit of ETH, a little bit of Bitcoin, still holding some bonk from bag days.
Okay.
Seems like there's been a little bit of an uptick there, at least according to some of the push notifications I'm getting. Not available on the Tasty platform. That is in a different, it's in the crypto wallet. But yeah, I mean, most of my stuff has definitely been just kind of on this like grind, it feels like.
Yeah, I mean, we've really been trading sideways. You look at February, the average price of Bitcoin is about 102,000. Look at March, about 84,000. And we've recovered here today. We flirted with 88, a little bit above there. But yeah, I mean, we've been going sideways. I would argue that Bitcoin, crypto, not all crypto, I guess let's just talk about Bitcoin. Bitcoin has been pretty resilient throughout all of this. My argument has been that while, yes, in the short term, when you have a pop in volatility like this, you're going to see correlations go to 1. Bitcoin's not going to be immune from the selling pressure at times or the volatility in the marketplace, but it's also not going to be impacted directly by trade policy, which obviously risk on, risk off headlines here as a result are driving markets. It's not likely to be impacted in the same way that Apple stock is. What I think is more relevant to Bitcoin and to the crypto market at large is kind of on a forward basis what happens with monetary policy, whether that's the Federal Reserve or when you look at it from the liquidity perspective, what happens globally from other central banks, whether they're cutting rates or there's some sort of stimulus. Maybe we'll see something out of China. And that could happen into the second half of 2025 calendar year. So I think maybe that's what you're starting to see the market price in here. Lower rates in the front end of the curve, weaker dollar, very weak dollar recently. You're seeing gold at all-time highs. As a result, you're starting to see Bitcoin look a lot more bullish than it has been. So we'll go through those signals in just a second. But I was able to find this study, and this is something we put together back in September, well, at the end of September 2024. Here are your average monthly Bitcoin returns. September historically has been a negative month for Bitcoin.
Okay.
The rest of the time, generally speaking, it's done okay, but this is that October, November, December, that Q4 period where you really start to see the seasonality pop up. And you saw that again this year. Post-election, we saw Bitcoin run north of 100,000 pretty quickly.
Yep.
Sold off in January, but Q4 did it again for us this year. Sell in May and go away, maybe, in that it kind of just has traded sideways, your average return has been about 5% on the month.
Yeah.
Versus that November period of blast off mode.
Yeah.
35% or so.
Yeah. Okay. Good to know.
Yeah, let me see if I've got anything else here. Yeah, average quarterly return, so Q4 outperformance there.
Yeah.
And then what happens when September is positive is another way to possibly look at it here.
Interesting. Okay. Well, regardless, I think though, we've talked about this a lot since you and I have started kind of doing the show together, which is you don't need to enter and exit your positions in one big bulk buy, right? Like you can layer on or take some risk off or nibble a little bit here if you think that we're kind of on the lower end of the range. And that's kind of what I'm going to plan to do as we go into, the end of this month and the beginning of next month. Because I do feel like maybe we have a little bit more upside, but I'm obviously going to try to do it and participate in a small way.
Yeah, and I think the other way to approach it too is, and we'll talk through this here, is to be aware of, what's working and just stick with that. Buy what's going up. And when all the cryptocurrencies are kind of chopping around and trading in different directions with different volatilities, I don't think you can really pick a bottom, right? We've seen Bitcoin market cap dominance at 60+%. It's at a new high, 64%, a new high in the last 3 to 4 years. That's been working. Trying to pick the bottom in Doge or something else just hasn't been working. And so when you have finite capital, you want to use that capital efficiently, and you're thinking about, okay, trading these ranges, or I want some allocation to crypto, maybe stick with what from a performance perspective is doing well on a relative basis, as well as when we look at kind of price momentum here, because you'll see that not everything is the same, even though we quite often talk about these things as being positively correlated and generally trading in the same direction. During these periods where you have a little bit of economic turmoil, arguably things are slowing down, markets under pressure, I think you look at Bitcoin. Arguably, you might look at ETH, you look at other larger market cap tokens versus some of the stuff that just goes straight up or goes straight down, is currently going straight down.
Yeah. That's a good call out.
But looking at our performance dashboard here, Katie, a couple of things that I want to signal. Bitcoin is now showing a bullish, I don't know if you want to call it a breakout, but in terms of the momentum signals that we look for here, we've just shifted from neutral to bullish. Still neutral on the weekly, but we didn't really get that breakdown. There were some warning signs for sure, but Bitcoin has looked a lot different, obviously, than Ethereum. Not seeing the same signals when I look at ETH, not seeing that really anywhere else. Bitcoin Cash has popped a bit here, and Solana looking a lot better. When I jump to a few of the other tokens that we've added recently, these are a lot smaller market cap tokens versus Bitcoin, seeing a slight improvement, going from bearish to neutral for Shiba Inu, Chainlink, Stellar Lumens, and Aptos. But again, maybe you catch the bottom and this all of a sudden reverses, you get a big upside move. But I would prefer personally to buy dips in Bitcoin at the low end of its range versus trying to pick, I like SWI long term, but it's been pretty bearish.
Yeah.
Maybe that changes. In the short term, it hasn't. So I don't think that you throw good money after bad there when you have a relative basis trade in terms of, or performance trade in terms of Bitcoin.
And when outside of the performance alone, and I know we've talked about your approach to this as opposed to like how we think about it in options or futures or something to that effect, but you're not only looking at like the price performance, but where is your head at in terms of like the innovation or the story that is happening for each of these individual cryptos as well? Or is it more of the price and trend play? Like if SWI was doing something like really interesting or breakthrough, like does that change your opinion at all right now?
I think so, but only if price follows suit, right? You need to be aware of I don't know if you want to call it the narrative, the fundamental story, the tech, so to speak, in the same way that you need to be aware of that in the equity market, right? There's certain themes that might be AI, it might be robotics, et cetera, et cetera. But regardless of how promising those themes might be on a longer term time frame, price is the only thing that matters. And you're in an environment right now where that high beta exposure is just getting absolutely destroyed.
Yeah.
And so you see that with NVIDIA, Tesla, Tech, Mag 7, the Qs. You see it on a sector basis, right? If I look at relative performance in terms of sector exposures, so I'm looking at not a screen that's up here that you can see, but I've got consumer staples is up almost 3%. That's the ETF XLP, up about 3% in the last month. On the other side of that, energy, tech, comms, healthcare to some extent. I mean, you've got tech down 12% versus consumer staples up 2%. As promising as some of those tech stories might be long term, this is not an environment in which those exposures work.
Right.
So you've seen a rebalancing and you've seen positions get taken down, right? You see that not only across sectors, but you see it in industries, you see it with factor exposures. And so, yes, you want to be aware of what some of these chains can potentially do, the use cases, what's happening from that long-term perspective. But at the same time, in this environment, the only thing that matters is price, and more so price momentum.
Yeah, fair enough.
But if you do have that long-term time frame and you want to dollar cost average into these, arguably you're getting much lower prices if you have that conviction. Now, ultimately, you need to see something go higher. But yeah, if you're adding to positions, it's not necessarily a bad time to add if you do believe that over time these are going to go a lot higher. We're just not seeing that today because, well, SWE is down 50% in the last 3 months.
Yeah. And kind of like a tangentially related question, and something we've kind of talked about, and I think it more so speaks to like the liquidity pools element of our conversations, but do you ever, or would somebody ever trade like the cryptos as pairs? Like in the same way that if I'm like, oh, the Russell is drastically underperforming, but the E-minis are not, like, is that a buy and sell or a buy depending on the correlation between the two opportunity for you? Or is that not as common, like in the way that I think about like cross-currency pairs of like the Aussie Canada or the Euro Yen?
It's absolutely a way to approach the market. I think in an environment where most things are positively correlated with varying degrees of volatility, that's where you find edge in relative outperformance or underperformance, depending on if you're going to go long or short. So absolutely. What's difficult though is structuring those trades versus what people call TradFi, traditional markets. Let's think about it from a futures trading perspective or from equities. It's easy to size those. They're standardized. It's easy to do that with futures. There just aren't many futures that exist, at least for U.S. investors. There's perpetual futures. But for U.S. investors, there aren't many ways to get that exposure. So let's take a look at it, because here's some trades that absolutely on a relative basis would be crushing it versus just being long Bitcoin. Maybe just being long Bitcoin is the way to play it, but you have that ETH short in addition to the Bitcoin long. On a 3-month basis, you're looking pretty good short ETH versus Bitcoin. The other side of that, you're really underperforming.
Yep.
And so this is one way that I would look at it. I'd also use this as a signaling mechanism. So if I'm looking at alternatives to Bitcoin, I want to price them in Bitcoin. And if Bitcoin is crushing them from that performance perspective, then why would I go into those? Just be long the benchmark, be long the S&P versus a single name.
Yeah.
And so when I look at that, Bitcoin market cap dominance of all the tokens that are liquid and that are tracked for the most part, Bitcoin's market cap is about 64% right now, the total crypto market cap. That's a multi-year high. And if we look at that from the momentum lens, it's very, very bullish. There's no signs of that rolling over. There's no rotation into alts. We haven't seen any outperformance in anything like Doge. To that point, Doge BTC is down almost 50% in the last 3 months, and it's as bearish as it can get.
Totally.
But if I'm looking at alternatives to Bitcoin and I think, okay, I want to be long Solana or I want to be long ETH. ETH has done terribly, so I look at ETH versus Bitcoin. Absolutely not. Solana versus Bitcoin and Solana versus ETH might give me some indication that outside of BTC, maybe I want a little Solana.
Sure.
Trade those ranges. So to answer your question, hopefully that's hopefully I did answer your question, but that is definitely a trade. You can structure these, but like going back again to the futures markets, the products just aren't sized in a way where, sometimes you're going to be long 20 ETH versus short 1 Bitcoin future.
Right.
To express the view that you think the ETH Bitcoin ratio is going to go in
like notionally,
ETH's favor.
what do we call it? Like weighting it from an implied and notional perspective, like you're saying, where it's like 2 pounds or 2 micro sterling to like 1 micro euro. Like it's just a lot.
You can do that.
Easier of a bite.
Yeah, but when you're going even volatility adjusted, let's say it's 18 ETH contracts to 1 Bitcoin contract.
Yeah.
It's still
Massive.
a lot.
Yeah.
And you have the fees associated with that. And so there isn't really an efficient way to express that, but I think that you'll see that change over time.
Yeah.
But in terms of how you might approach the market, or you think about just allocating capital to one token or another, this is one way to look at it.
Yeah, because I think that that's important to remember is like the biggest thing that grammar, Katie.
That's okay.
The biggest thing I've taken away from our conversations is that this isn't a case for you or a trader to make their entire portfolio crypto. It's considering adding it as another tool in your repertoire for you to engage in when markets are moving or when they're not moving, more or less. And so to your point, whether that's with static outright plays and benchmarks, or if it's more of a pairs and relationship extreme, just having this information, and especially the time and energy you take into building these performance dashboards, this is where I see the most value.
Yeah, and I think from a portfolio allocation standpoint, there's a pretty strong argument around, let's call it between 1% and 5% of a position relative to your entire portfolio in something like Bitcoin. I'm not saying that you go into Shiba Inu. There's something for everyone, but if you just look at this from the perspective of Bitcoin and allocating, some of your money to crypto, why would you want to do that?
Yeah.
Well, historically, you've seen asymmetric returns. Yes, it can go down by a lot, and it's gone down 70, 80% at times. There have been real catalysts in the market, FTX collapse being maybe the most recent, where, you kind of question if this is real. I think we've moved past that.
Yeah.
But on an annualized basis, the asymmetry is pretty prevalent. And so you kind of want to be in this, right? The upside is much greater than the downside, so therefore maybe you want to own a little bit. The other thing to consider is that majority of the time, this is a low to no correlation, certainly over longer time frames, to equities.
Yeah.
Here is a good example of that today. Well, again, when volatility breaks out and you have a significant move from a VIX that's sub 20 to a VIX that's plus 40 or plus 50, and vol is plus 150 or higher, Bitcoin's probably going to get taken down, because this is about liquidity more than anything. This is about reducing those volatility exposures in a systematic way across much bigger portfolios than you and I are trading. But outside of that, Bitcoin is driven by things that are going to be impactful to equities. But, on the margin, it's not about a company's earnings or economic growth, right? A lot of this might be liquidity in the system, financial system globally, might be interest rate related, it might be currency related, but it's not going to be driven by the exact same thing that's going to drive other risk assets like equities, at least not all the time. And so again, I think there's a pretty strong argument for having something in this at this stage relative to where adoption is and kind of where we might be going.
Yeah. And when you're saying that to the 1% to 5%, right? That applies, and this is a question we get on the road a lot, so that's why I'm asking it, but that still applies to if you are in a $5,000 account as opposed to if you're in a Sosnoff-sized account.
Yeah, absolutely.
Several commas, but
it might add more volatility to your portfolio, but the performance outweighs any increase in volatility. And the other thing to consider is that a lot of times the volatility increase is a result of the price going up, not going down. And that, again, speaks to the asymmetry. So we are going to do some shows in the future on the road where we'll talk about this in more detail. We also have some guides coming out that'll speak to this in terms of portfolio allocation. But that's how I think about it.
Yeah.
Before we wrap things up, though, Katie, really quickly, want to just take a look at expected moves off of spot prices or close to them. Bitcoin, you're looking for about a $6,000 weekly one standard deviation move. ETH 150, Solana about $20, Doge about 2 cents, and XRP right around 20 cents. There are your ranges. We are seeing the low of the Bitcoin 1 standard deviation move has been trading higher here, and you're seeing a series of higher highs more recently with the top of that range. So the range is 71 to 93. ETH 1424, 1726. You can see the rest there up on the screen. But again, Solana Bitcoin looking a lot better recently, getting those bullish price performance momentum signals here. When we look at the exponential moving average crossovers, man, that's a mouthful. But, you're seeing, I guess what I want to say is you're seeing some bullish signs here in Bitcoin Solana. Maybe ETH follows suit, maybe it doesn't, but Bitcoin looking a lot better than it has been.
Lovely. Yeah, this is super helpful to me, again, as somebody who doesn't necessarily always understand like just the straight implied volatility measurement because of the volatile nature of these products. So being able to break it down into like dollar amounts, I think is particularly helpful for somebody who's relatively new to this space. So appreciate your time putting this together.
Well, appreciate you coming on the show, Katie. That's going to do it for today's show. Victor Jones is up next with The Price of Truth. You don't want to miss it. We will be back on Wednesday. I think Dan and I have another interview.
Hell yeah.
With a very special guest. So looking forward to that on Wednesday. We've got Greg from Amber Data coming on. So we're going to be talking to him this week. Tune in for that. You don't want to miss it. It's going to be jam-packed with a lot of good market insight. So it's always fun to talk to Greg. I don't think we've talked to him on the show, but a friend of mine. So looking forward to having that discussion.
Great.
That said, we'll be back Wednesday. Until then, I'm Ryan.
I'm Katie.
Peace.
Peace.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
I want to play a game. It's a relationship game. So I'm going to ask you each a question.
Who loves the hardest?
Yes, yes, yes. So are you ready? Who's more stubborn? Who's more public? Who's more patient?
These are two of the least. These are the least patient people I've ever met.
I'm going to say him just because he's a little older than me.
Who calls or texts more? And who do you think takes longer to get ready in the morning? Who's a better driver?
I drove a truck in New York City.
I can fly an airplane.
Who loves the Fed the most? Who's the bigger spender, do you think?
Me. Yeah.
Who's the alpha in this relationship? Who is more spoiled?
Oh, him.
Who do you think is funnier? Who is the better debater?
I'm gonna give it to him.
Dylan, you think you're the better debater? Are you the master debater?
No, he's good because he doesn't answer the questions, which is great for debating.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
I distinctly remember getting an email from Tasty that Look Back had just been released, and I was doing the most laborious back test on the face of the earth before that. And I did 2 or 3, and I saw how quick it was, and I saw how quick the data was, and basically instantaneously, like, I was hooked. I'd always seen all the stuff on Tasty Live with all the data and all the value I thought that bring, and then it was all of a sudden I could control that and basically make my own segment for myself of what fit. And that democratization technology, I think, drastically changed not only the landscape of what's out there, but drastically changed my ability to learn at such an insane rate. And that's kind of when I developed a little bit more of my own path. I was like, this is the type of trade I exactly want to see, or I'd get some type of inspiration from Tasty Live to look at that. And that's when my consistency went from like 1 to 30, and I haven't had an unprofitable quarter since.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Oh, yeah, it is Monday, April 21st, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast called The Price of Truth, a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world, and good God, are they giving us a lot of incentives? More on that in just a bit. We should say what's up to the people. Shout out to everybody watching on tastylive.com, as well as all of you degenerates watching inside of the Tasty Trade desktop and mobile applications. If you don't already have both, go get them. Make your life a little bit easier in 2025. Lord knows we've got enough difficulties. But if you want to be part of Bing, this little chat box on your screen, there's only one place to do it, and that's on YouTube. So head on over to Tasty Live's YouTube channel, jump in the chat, subscribe to the chat so that all of your comments, both appropriate and inappropriate, can be displayed on the screen. Try to keep it PG, though, and start bashing your fingers, phalanges, and metacarpals, your skull even, into the keyboards to type in random-ass characters. The more you type, the more you spoof the Google algorithm into putting us in front of as many people as possible. Shout out to everybody in the chat: Katan, Michael, Rezo, Sleepy, Victoria, Cato, Ben, Brian, I think I saw you in there, Theta, Katan, I think I said your name twice. Go buy a lottery ticket. Shout out to all of you. I would sit here and just shout your names out for the next 90 minutes, but I'm contractually obligated to say something that can be interpreted as something of substance. First and foremost, let's address the elephant in the room. I got a haircut in Indonesia, and as I said on Twitter, Trump put tariffs on their country, and I think the barber took it out on my hairline. I got a haircut in Indonesia, and the barber left my hairline in Malaysia. I wrote out like 10 of these. So, you know, it is what it is. The hair grows back. I'm fearless. Is anyone else fearless when it comes to haircuts? Like, I'll go get one anywhere. I remember I was in San Francisco. I was a young dude. I'm in San Francisco. And I'm looking for a barbershop. And that was kind of, this is how old I am. That was before there was like internet reviews. So if you wanted to go get a haircut out in San Francisco, you kind of just walk around and look for the barber pole. I see a barber pole. There's 3 black dudes standing outside of this barbershop. So I'm thinking, all right, perfect. I go in the barbershop. There's 2 elderly gentlemen, elderly Asian gentlemen cutting hair in the barbershop. And I'm like, okay, strange. Wasn't what I was expecting, but if these guys have their vote of confidence, I'm going to go in here. This is what you call judge. This story is called judging a book by its cover. I go in. The gentleman says to me in sort of broken English, what can we do for you? I said, look for a haircut. Gets on the phone, calls somebody in the back,
this younger Asian gentleman comes out of the back. Kind of, I would say he's sashayed out of the back. I wouldn't say he just came out. He comes out of the back. He sashays out of the back. There's like these hanging beads, and he sort of like floats through these hanging beads in the back. He's got bright orange hair, bright orange Crocs on. At the time, I had never seen a pair of Crocs. I don't know if I should be telling this story. I just realized I don't know if this is how you start a 90-minute stream. Long story short, this gentleman comes out. He was an eccentric character. But there was a moment where I'm looking out of the window at the three gentlemen who are still standing outside the barbershop, and I'm looking at them like, what? Why are you standing there? That's false advertising. They're looking at me like, what are you doing in there? This is not the place for you to get a haircut. Long story short, that one ended up okay. I ended up seeing Frankie Walsh later that day, and I told him the whole rest of this pretty funny story, which I'm not going to do here. But anyways, get all your haircut, get all your Stephen A. Smith jokes, get all that stuff out. Get it all out now, and so we can go 90 minutes. It'll grow back. All right. You didn't get a good haircut when you come home, and I got a wife and two kids. Okay, so I come back from the haircut. Everyone just looks at me and then goes on about their business. That's like a weird moment. All right. I'm just kidding, being a little vain and just having a little fun. All right, S&P 500, everybody. Didn't do so well, huh? Didn't do so well. So it turns out we couldn't hold what we knew would be sort of a very determinate place in the marketplace, getting back up to that 5,500 level. I kind of said this is make or break time. And we did not hold it for one reason or another. You can call it technical. You can say, we don't have the greatest fundamental data here, greatest macro data over the weekend. The trader says a better haircut than they gave that chick in the new Snow White flick. Yay! Zing! All right, let's keep going. Yeah, man, it was pretty ugly today. Another 2% down day. That's what 29, 30 VIX where we were coming into this week. That's kind of what you expect, right? But we did get SPX down 2.33%. NDX, the NASDAQ 100 down 2.5%. John Godin says the market has that hairline running for the hills. Bro, the barbers that just make their own line. They say, I see your line and I'll raise you one. This is where I want it. The Dow Jones is down 2.5%. The Russell down a little bit more than 2%. So it was an ugly day across the board. You can make an argument that Russell slightly outperformed, though I would say a 35 basis point outperformance is not much to get excited about, quite frankly. So ugly across the board. Volatility raised VIX up to 33 and change in VIX cash, and 28.5 in vol futures, front month vol futures. Let me quickly get the vol term structure in front of everybody here, and you can see we are still in backwardation, people. And this is, I forget the statistic offhand. I should have it offhand. But there are not many times where backwardation in history lasts more than 10 days. And generally, those times are etched in market participants' minds. I think this probably goes without saying. I think most people knew that after April 2nd, that we were likely in a period that would be remembered throughout the echoes of history. But if it needed to be explicitly said, let's put it out there. So we're in pretty decent backwardation. VIX cash well above front month futures as well. And just by the rule of 16, you should be expecting 2% swings, man. right? At a 16 VIX, you're expecting a 1% move 2 out of every 3 days. And at a 32 VIX, you'd be expecting 2% inside of 2% moves 2 out of 3 days, and 1 out of every 3 days a move outside of that range. So Vol is telling you, man, if you're not ready to defend against 2% moves in your portfolio or in your trades, in the majors, by the way, we're talking 2% in the majors, not your underlying stock, then perhaps this is not the game for you. Maybe you should go sit down on the sidelines. Bonds at 113, creeping a little bit lower. And this is, I'm going to keep saying this. I'm going to keep, now, in fairness, we are getting towards the bottom side of this range. Meaning, let me just quickly put this on the screen. We played that little bounce in bonds pretty well. And our point of view was, I'm going to speak to the collective here. Maybe you didn't agree, but what on this show, what our point of view was when we had that bond blow up right before the 90-day pause, I wasn't so sure that was just, there was a couple of narratives out there. One narrative, that's China, that's Japan, that's the rest of the world blowing out their U.S. Treasury holdings, maybe. That is some big player or set of big players getting blown out of their positions, and that's the market ripping their eyeballs out on their liquidation. It seemed like that was actually true. That was part of it. Or some, perhaps, this is not mutually exclusive with the other two, some bigger underlying issue with the plumbing, that's happening. And that looked like it was true as well, sort of a basis trade blow up on a highly leveraged, highly leveraged treasury trade that seemed to have blown up. And so the point was that was sort of it. That was likely an interesting low to trade against, and that we would maybe get back to a 115, 117 level. We kissed like 115 almost exactly. And now, we're going to test, it looks like we're going to test that low. I don't know what we do in the super short term. I don't love betting for or against it here. All I know is that I think a lot of people are doing the same thing that they did back in September. And I understand why it's even more tempting this time. So again, back in September, here's the prevailing narrative. We're going to cut rates. The whole curve is going to come down. And we just didn't think that was going to be the case, and it did not happen. Here's the reason why people will rationalize it, and what they will say is, well, the economy was not slowing. Growth was not slowing. There wasn't a recession risk on the horizon. The economy was still strong, or some of the numbers are still strong. Therefore, the market can interpret that as sort of, long end yields should go up because there's more growth, more potential inflation given those cuts. That's the way it'll get rationalized. So this time, now that we've got slowing growth, potential like geopolitical concerns, who knows? Who knows where this sort of tariff tit for tat leads? That this time, people are going to buy bonds. And it's different this time if Jerome Powell and the Federal Reserve starts cutting, as the implied curve is saying. I'll take you there really quickly. Implied curve says June 18th, there's a 4 out of 5 chance that we start or continue this cutting cycle. And that very quickly thereafter, in July, you got to cut again. In September, you got to cut again. October you may hold, but December you're going to have to cut again. So you got 4 cuts from now to the end of the year is what the market is saying. And for some reason, I think people think, again, this is the whole curve's going to fall. And that's why people want to own long end bonds. And I just don't think I don't think it's going to happen. I think best case scenario, the long end sits still. I think best case scenario, the long end sits still. And here's the thing, even if I'm wrong and long end yields fall, in my personal opinion, as I'm sitting here at the card table trying to read people, I think the administration only uses that as justification or validation for escalation. I sound like Al Sharpton. Justification, or maybe that's Bernie Sanders, justification or validation for additional escalation. They'll look at that as more chips on the table for them to make bets. In which case you could see additional destabilization, which only raises the risk premium in the long end and brings you back to where you are. But for every reason you want to buy the long end, which is on growth concerns, I don't where do you think we're just going to go through a growth slowdown here? And what do you think the fiscal situation of this country is going to look like if we go into a growth slowdown, a material one? I think people really want to look in their playbooks, and they really want to look at the last 20 years of history, for example. Here's my biggest problem too. You look at a chart, in most of these charting packages, it doesn't even go back far enough for you to have the data to look at a situation where something like this has occurred in the past. You can't go back to the 70s and 60s in your charting package. You can't go back to the 40s and 30s in your charting package or your data sets unless you're paying a serious amount of dough. So most people are doing their analysis with 20 years of data. Tell me in the last 20 years when you could point to a highly inflationary regime. You cannot. So all that data set that people are using ChatGPT to come back and throw up on people, I don't think it's relevant. I think when you've got a high inflation regime and a really ugly fiscal situation, high levels of debt, I think the playbook changes. And I think there aren't going to be a lot of people that want to be the suckers at the table. And I hate to say it like this, but in some way I can see the long end holders being the suckers at the table. I can see a lot of people being the suckers at the table, man. I just think it's going to be hard to protect capital here. You're in cash and they print, you're screwed. The only people making out here are the people that are holding sound money. Who would have thought? Let's see what the people say. Brian Watson got it. Jesse Jackson. Grumpy Mike, not so much. Bo Jackson, not so much. Victor, we spoke about this. A good Fed operation twist would help. Yeah. It is possible, but it is very possible. I wouldn't put that out of the cards. But I would say all else equal, right? If they do nothing but just cut or they bring down QT to nothing, I think all else equal until they do something to try to manage the curve, I think what I'm saying is real. I think and when you get Fed intervention in the curve, if that's what you get, yeah, of course, all bets are off. I think all bets are off at that point. I would agree. Katan. Rezo says we need a reset recession and lower the debt. Lower the debt on a reset recession. I don't think you know how painful how those words come together in a stew. Maybe you do. I think gold bugs are doing good. They are, which is always it's always a bit of a scary market when gold, it looks like an altcoin. That's probably not good, because it's telling you more about what's happening to the dollar right now than what's happening to gold, right? It's telling you about what is happening to the dollar, what people are expecting to happen to the dollar, which is, again, that's why, why would people be running out to buy bonds here? It's not going to happen. You'd see the opposite. You should see higher yields because of what people are thinking is happening and going to happen with the dollar. And I just think you got to be careful with that. I think it's such a it's a first order thinking type play. If recession, then buy bonds. Yeah, I don't think this time is. I don't think if highly inflationary regime with completely fiscal undisciplined government who will pay you back in funny money, I don't think that is the same scenario. I would be real careful, man. I hope I'm wrong, by the way, because that has severe consequences. If we're in an environment where the 60-40 portfolio gets decimated, or at least the 60 part of the portfolio, which is equities, is just kind of leaking lower, and the 40s are not doing well, that's a rough position to be in. Stu, buy tulips. We got BTC, and it's now decoupled. Yeah, I think I saw something. I said this on Sunday, and I've been saying it, to anyone who would listen. Some people at first fought me on this. They said that, no, it's not decoupling. The move in Bitcoin just happened first. I was like, okay, maybe. It did come off from 109 down to, it touched 75 at one point. And that is what, 35,000 points, something like that, which is a pretty decent percentage move off the highs. I think that's fair. But I also think this is many people have looked at this asset for all the narratives it has gone through. And the one thing that has remained consistent, this is a high beta NASDAQ. This is a high beta NASDAQ. This is a high beta NASDAQ. And the decoupling that I started pointing out was, this is a high beta NASDAQ, but it's if the dollar is getting murdered, then this that you have to factor that in here. Somebody else, what was his name? I think he framed it as, I'm forgetting the name offhand. He framed it as, it's a NASDAQ that's denominated in a basket of world currencies, which I thought was a good way to frame it. So if the dollar gets murdered, this thing doesn't do so bad. And that's, I think that's what you're seeing here. Bitcoin at near 87,000. What's really interesting is dollar-denominated assets. Dollar-denominated stores of value doing okay. Dollar-denominated assets that are predicated on growth leaking lower, if not getting murdered. If you told me the dollar was going to get crushed like this, and you also told me that all Mag 7s were going to be doing horribly during that time, I don't know that I could have believed you on its face. T-bills since inauguration, 100, Catan. Yeah, I think that's the harder thing to do right now, is go bet in long-term U.S. debt. I think that's a really tough bet without a little bit more clarity on how exactly this tariff trade thing, spat, gets resolved, on how the growth situation or growth picture looks, and what the government will do in response, and what monetary policy will do in response. We've got this weird Mexican standoff happening right now between the U.S. government, the fiscal authority, between the monetary authority, and between effectively the rest of the world. and everybody's pointing a gun at each other. You could say the rest of the world is really China, and there's this like three-way standoff happening. And I think in that scenario, hard to go make a 30-year bet on the U.S., hard to go make a 10-year bet on the U.S., a lot easier to go make a short-term bet and get paid 4 or 5% to do it. And so, I think a lot of people are looking at the yield curve here. You're looking at short end, getting paid anywhere from 4 to 4.5 to stay super short term with your treasury bet. Just get paid back with a high likelihood of getting paid back your real dollars with a little yield on top of it. And to Katan's point, I think a lot more people feel comfortable with that short end of the curve, buying up the short end of the curve, and leaving the long end of the curve for dead. And you can see what's happening. Long end of the curve exploding higher here. It's above all of the yield curves that we've been plotting, while the short end is dropping because the market is expecting the Federal Reserve to drop rates by 100 basis points between now and the end of the year. You can see how they expect that to impact the long end. Is Ray Dalio finally going to be right? Says Mark Aguilar. I think my personal opinion is Dalio's right about this cycle. He's had a couple of bad timing calls in the last couple of years. Like in 2022 when he came out and said cash is trash. He had a couple of bad timing calls. But I think he's right about just the general big cycle that we're in right now, unfortunately. McNutty says, I just don't see how anyone wins right now with what they're doing. In the end, everyone is going to lose. So McNutty, I don't disagree with what you're saying. I actually think it's a pairs trade. So let's say right now, today, you were long the Russell, you were short the NASDAQ. Both of those sides of the trade lost. Both of those sides of the trade went down. But the thing you were short went down more than the thing that you were long, so you would have made out a winner by 35 basis points. So I think the idea here, in the short run anyway, again, I'm not saying it's going to work. I'm trying to work through what I think the logic is that in the short run, this is a pairs trade, and that the idea is that we are short China, we're long the U.S., and that the pairs trade is that what is happening right now will hurt China more. In other words, the short side of our trade is going to be more profitable than the loss we'll take on the long side of our trade. I think that's what but on a relative value, all prices come down. In other words, this does hurt the U.S., this does hurt the rest of the world. In many ways, this does hurt China. But what does happen for sure is that some of the liquidity pool that's in the United States, given the full faith and credit of the United States, given the rule of law in the United States, given the predictability of the United States, I think some of that has very clearly been called into question. And so who is the beneficiary of that? Well, that liquidity is going to go find a new home. And I think at some level, what you're starting to see and what you have seen is that liquidity go find a home in Europe, right? That liquidity goes and finds a home in other international markets. And you've seen some outperformance in international markets, I think, just because excess liquidity, excess dollar savings, that almost always got recycled back into the U.S. financial system. And I think what seems to be happening, and I don't want to make the claim that it is, but what seems to be happening is that final part of the cycle, which is to bring the excess dollar savings, to bring all that back into the U.S., might not be happening. And so one of the reasons you see so much pressure on dollars is those assets, excess dollars being sold. and then that excess liquidity is finding its way into an international market. Broken clock is right twice a day. I'm guessing you guys are either calling out Dallio or Peter Schiff, because I see you guys talking about Peter Schiff here. You know things are bad when I'm paying attention to what Peter Schiff is writing on Twitter. I think, me personally, I think Peter gets a bad rap, and I think it's undeserved. I think he's generally right about a lot of things. But I think what he does is he sees the world through his view of money and not the game that the monetary authorities are playing with money. So his quote unquote predictions are based on what would happen in a world where money was respected a little bit, where the principles of money were respected. And I think what we are doing is we're playing this extend and pretend game. And so each time they extend and pretend, he goes, okay, we didn't take this path. They played the game. They papered over the problems, and it's only going to make this bigger and worse in the future. And I think I see Vol. I see Vol as sort of a metaphysical thing. And the more we try to dampen financial volatility, the more we just sort of transmute it into other bigger problems that we have to pay for in some way, shape, or form. So I don't know that I would say he's wrong. I think he's a good showman. But yeah, I mean, I for his analysis at face value, I've kind of got a lot of respect for what he says. I don't watch him all the time, but every once in a while I'll come in contact with one of his videos or something. I don't watch him on Twitter. He seems like a bit of a troll on Twitter, but like that's if you're going to play Twitter the right way, you know, there's a bunch of people out there who do that because they sort of understand the algorithm. It's a quick way to get a couple 100,000, if not millions of followers. Kathy Woods. I think the most dangerous thing that can happen is we start talking about those funds again. That would be really dangerous because that means they lit up that printing press again. That was the best thing about that time frame. Is like it was so clearly obvious that she had a fund full of just the highest beta objects that you could buy. Semi-liquid or decently liquid, highest beta. And we just, the amount of liquidity that was added to the global marketplace in a short period of time. And like nobody cared. Nobody talked about that aspect, right? Then you raise interest rates and it completely destroys all high beta, high growth instruments with high predictability of future cash flows in the future, which are tied even more so to the cost of money. And her fund gets destroyed. And nobody talks about what was the primary fuel for the growth of those funds. Nobody talked about why that fund got destroyed. They were trying to justify it in models and fundamentals and all this exciting narratives around gene therapeutics and like all this stuff. It's like, okay, but really, why do you have so much money in Netflix? What's the innovation there, bro? It's just a liquidity sponge because you have a bunch of money you have to figure out what to do with. And ultimately, you ended up picking a bunch of Mag 7 stocks to manage that liquidity against all the beta you had. That, to me, clock is the thing in the middle of Vecchio's new Cayenne. Did he buy one of those, Brian? Please tell me he didn't. Please tell me he did not. I had one. I explicitly advised against that brand. It's a great brand. It's a great car. But the depreciation isn't worth it. Fun car to drive. Anyways, let's keep cruising here. So anyway, I do think unless Catan is right, unless you do see some twist come out of the Fed, either explicit or some stealth program, I think we continue to see more of the same. I do not think this is going to be good for the long end. And sort of the flip side to this, and I wrote this out. Let me pull this up if I can. So I wrote this out. The most interesting problem here is that the worse the negotiation goes, the worse the expected economic damage. Therefore, the more the market expects the Fed or fiscal authority to respond. But reflexively, the more the market expects the Fed to respond, the less they have to respond. In other words, the market eases the financial conditions so that in a way the Fed has less urgency to do so. Here's what that means. The worse the negotiations go, the higher long end yields go, and the lower short end yields will go, the steepener, in my opinion. The better the negotiations go, long end yields will come down and short end yields will go higher, the flattener. This is probably the opposite of what people expect. What do I expect? I expect the data will show slowing growth and that will pull yields lower. But if so, Trump will use it as a bullet to fire in his negotiations. In other words, it won't pull yields lower, it could. If I'm wrong, it could pull yields lower, and if so, Trump and the administration will use it as a bullet to fire in their negotiations. But if long end yields do not give Trump a card to play, which I suspect they will not, meaning they will stay elevated, then Trump gets put in a bit of a box. And I think that's likely the direction that we're headed. Yields stay elevated, which sort of puts the administration in a box and forces an off-ramp here. Otherwise, it forces them to act just completely, who knows? Who knows? It could get really dangerous, you know. You put somebody's back against the wall, whether it's China or the U.S. administration, they can surrender or they become desperate. And I'm worried about either of the parties in this negotiations back being put up against the wall and either side getting desperate. I'm really concerned about that. I want to take you through my thoughts on the probabilities as I see them, and I could be totally wrong. Brian Watson, I'm joking, I'm back. Okay, good. All right. I'm going to read you through sort of the outcomes as I see them, the decision matrix, or maybe a bit of a probability distribution of outcomes with my totally unscientific probabilities assigned. And I would be curious in the chat. You guys are more than welcome to put your probabilities or where you think I'm wrong or where you think I might be looking at this is in a short-sighted manner. But I'm going to read you through how I think this could play out. I guess this is the decision matrix as I see it now. There's no real science behind these probabilities, and I'm sure there are some contradictions. I just had some time to scribble this out while in transit, so on my way back from Indonesia to Singapore. Open to anyone else's opinion, as I could be way off in my thinking here. Too long didn't read. I find it hard to see us finding a material off-ramp in the next 3 months, which means I still think markets are optimistically pricing these scenarios or outcomes. Scenarios. A, material progress on ex-China, so everyone else except China, material progress on those trade deals or MOUs are announced in the next 90 days. But no material progress is made with China. I think there's a 50% probability. That's the highest likelihood outcome. Another scenario here is the material progress on other countries' trade deals are announced in the next 90 days and material progress is made with China. I think that is a very low probability. I'm handicapping it like 15%. I think the longer this goes, the lower this goes. This is going to go to a zero delta. C, no material progress is made on other countries or the rest of the world, and no material progress is made with China. I think there's a 35 or 1 1/3 probability that no material progress is made at all. And I suppose the fourth scenario is that all of the issues get resolved inside of 90 days. I think there is a snowball's chance in hell of that happening. And so I think you can probably make a good argument that you could flip these, that there is a 60% chance or 50% chance that no progress is made with any countries and no progress is made with China. I think, though, that puts us in a really desperate situation. I think a 90-day pause where we have nothing to show for it is it's going to be looked at as a failure, and there's going to be a lot of pressure to bring this thing to a close. And I think the U.S. has a lot of economic and military power. I think they have enough allegiance to make something happen in 90 days, to make some announcements, and it seems like we're already down the path of that happening. So I think the more likely scenario within the 90 days is you get some material announcements between the U.S. and some other countries. I think you probably get additional announcements between China and other countries, and no progress is going to be made between the United States and China over the next 90 days. So that means when you get to the end of the 90 days, all these scenarios resolve themselves to either the effective tariffs going up, down, or staying the same. And I think we're going to have to account for some countries are going to escalate. Some countries are going to de-escalate, in other words, make deals. And then there's likely going to be additional industry carve-outs between now and this additional 90 days, I would imagine. So, the Tim Cooks of the world were able to lobby, and a lot of these Mag 7s were able to effectively lobby for some industry carve-outs. I think you're going to get the next level of individuals or businesses that are going to be able to lobby some carve-outs within the next 90 days. And ultimately, that's going to leave you with the effective tariff rates going up, down, or staying the same. And I'm making the bet that I'm guessing some tariffs are going to go up, some are going to come down or get alleviated altogether. And then there's going to be additional industry carve-outs, which will put downward pressure on it, and all of that will probably leave tariffs somewhere close, effective tariffs somewhere close to where they are. Maybe 20% probability they go up and a 30% probability they go down. In other words, if they don't stay the same, I think there's a higher probability that effectively they go down, which ultimately means that at the end of the 90-day window, we have 3 scenarios. Most tariffs go live. I think that's a low probability. I think there's a 1 1/3 chance that most tariffs are postponed again. What I think is the most likely scenario is that we have a new bucket. So right now, Chinese tariffs are live. Others have been postponed. I think what happens is you get a new bucket of countries that will join China with live tariffs. And other countries who have made satisfactory attempts at a resolution are going to get another round of postponement. I think that's the most likely outcome. And I suppose there's, again, a possibility that tariffs altogether are canceled. Again, a snowball's chance in hell. So that's kind of the way I see the world. And the potentials, and with my assigned probabilities going into this next 90 days, with the most likely outcome is a few announcements, no material progress of China, effectively the same level of tariffs, if not a little bit lower, and maybe a country or two or a handful of countries that get live tariffs and the rest get postponed. That's kind of my highest probability outcome of the next 90 days. Let me see how you guys are responding to some of this. We'll move on to some instruments here. But he will still claim victory either way. The damage is done, and I would not expect a rally. I don't think that's going to happen. I think a lot of people think that's going to happen. Sort of there's a phony announcement that everyone will see is not material, and a claim of a victory, and everyone moves on. As you can see there, I don't think that happens. I think that's a very low probability in this round, in this 90 days. But we'll see. I think that's what people want to happen. I think people want to see this as, okay, this has failed. This is going to do a ton of damage. The longer this goes on, everyone sees through the negotiating leverage ploy. China's playing hardball. So cut the shit, cut the charade. And I do not think that that's not my read of the players at the table. I don't think that's the way they're going to play the hand. That's just my guess. I think that's what we want. I think a lot of people want that to happen. Okay, quit this, it's over. Let's go back to the way things were. And I just think we've crossed this paradigm where I think, there was this moment of during the pandemic where I think a lot of people just wanted to go back to the way things were. And I told my wife that whatever that life and lifestyle and rules of the road were, we never go back there. Something fundamentally shifted just now in the balance of power, the balance of wealth, the economy, how labor and capital work together, how we live our lives, the expectations of a government, the social contract between the people and their government. I said there was a fundamental shift that just occurred, and people that want desperately to go back to the way things were, it's human, but it's not going to happen. It's going to take a long time for people to realize that. I sort of get this feeling that we've crossed this new paradigm, and I do not think we go back to the way things were on April 1st. And so maybe I'm wrong, maybe I am wrong, but I do think we've just fundamentally crossed this into this new paradigm. And if so, I'm trying to wrap my mind around what that means. I think people get pissed at me for doing that because they desperately internally want to go back, and they want me to say that's going to happen too. Because if I'm saying this other thing, that makes them angry, it makes them scared, it makes them uncomfortable. But my role is not really to make you scared or uncomfortable. It's just to be honest about the way that I am seeing things. And I really do not think this is just going to end with, okay, everything's canceled. We've made some great deals. Let's move on to the next part of the administration, the next part of our agenda. I don't think that's the way this happens, man. It's not going to happen in 90 days for sure. That's my opinion. Lucky says, I think the issue resolved outcome is much higher, though I would rephrase as Trump caving. Yep. I'm not mad at that. I'm not mad at people revising that outcome higher. I'm not mad at it. But I guess I'm telling you my view of the world is I don't see a snowball's chance. I kind of like that that's the most, I think kind of like that that's where everybody's challenging it though. McNutty says the worst policy I've ever seen crushes small businesses that are already struggling. How anyone thinks this is a good idea. I think, McNutty, I think you're right about small businesses. And what's crazy is the shutdowns during COVID, they were clearly and obviously going to harm small businesses the most. And they were going to allow large corporations, those with lots of capital, working capital, those with lobbying power to lobby themselves as essential businesses to be able to stay open, those with the resources to sort of re-engineer their business. And like that was this moment that clearly had this long-lasting damage to small business. And I think the longer this goes on, is allowed to go on, the more it's going to crush small businesses and consolidate power into the hands of larger corporations. And it's funny to me that no matter who you put in the Oval Office, the winners and the losers seem to be the same. The losers seem to be small business. The winners seem to be large corporate power. And with one side of the aisle for a few years ago, it was subsidies to large corporations or lobbying favorites. And in this situation, it's subsidies to large corporations or lobbying favorites. But it's not a subsidy, it's a tariff exemption. So I'm not with you, or I'm not against you here, that who it impacts the most, it's the people in the middle, man. I'm going to read a couple more of these, and I'm going to move on to a couple more instruments here, a couple more topics I wanted to talk about. Small businesses struggling is why I bailed on small caps. Yeah, it's just a tough trade. Because the whole broadening of you bet on small caps in a broadening of the economy. And that's not what's happening here. The economy is not going to broaden out. There's going to be a particular portion of the population and size of business that's going to take the brunt of this pain, and those are the ones running shoestring budgets with low amounts of working capital. And those people are going to fold up shop, and then likely subsidies then are going to come from the government to try to maintain political favorability with that base. And that where's that money coming from? That keeps long end yields high. It keeps the dollar in the toilet. So we'll see. There can't be a resolution if we don't even know what success looks like. I think we do. I personally think I could see what success looks like if I'm viewing the world correctly. I think what success would look like in the mind of the administration is lowered tariffs, lower non-tariff trade barriers, whatever. An example would be, it's really hard for a bank to go set up shop in Canada. TD Bank is huge over there. It's really hard for U.S. banks to go over there and compete. From a regulatory standpoint, it takes forever. And it's really hard to do it. So a non-tariff trade barrier would be making it easier for U.S. banks to go do business in Canada. I'm just giving an example. So success would look like deals that remove, or another example, this is a funny one in my personal opinion. We can't export, many countries won't take our beef, right? Or they won't take our corn. Or they won't take a lot of our products that we put these seed oils in or these dyes in. And so the funny thing is we don't even want that shit here. Like part of the reason why, at least in my personal opinion, part of the reason why RFK Jr. was able to amass the political power necessary to put him in as Secretary of Health and Human Services, whether you agree with it or not. But part of that reason is there is enough of a movement in the United States that says we don't want these seed oils in our food, we don't want these artificial dyes in our food, we don't want this glyphosates on our vegetables anymore, we don't want these PFAS. Like, there's a movement in the United States to get rid of all this shit. So it's sort of logical that there are a bunch of importing nations that go, no, thank you. But an example of removing a non-tariff trade barrier would be some of those countries saying, okay, we'll accept your beef, or we'll accept your package, your artificial, your processed food here. And so you get a couple of those coupled with lowering tariffs on American goods. And I think that's probably viewed as success, but not ultimate success. In the mind of the administration, you want that plus. And what the plus is you want them to agree to be on your side when it comes to the larger negotiation between the U.S. and China. So you want them to agree to help you to close tariff loopholes with China and to make sure that China is not going to use your lower tariff rate to set up business and then export to America. You want that country to agree to impose tariffs on China along with you, so that increases your negotiating leverage in that discussion in the U.S. v. China. I think that's how they view success. I think other countries are not going to want to do that. They need the demand from the U.S. They need supply from China. So there's not going to be a lot of countries that are going to want to put themselves in the middle of this between us. I think that's what success looks like to the U.S. To answer your specific question, I think the probabilities of getting the last piece, I think it's really low. I think the probabilities of getting a bunch of countries to sign up on the U.S. side against China, I think that's hard. And I think China sees that that is the desired outcome from the U.S.'s perspective. And I'm going to tell you why I think that. Because the China just put out some threats from their side to the United States side, and this is how it reads. Appeasement will not bring peace, China warns against trade deals with U.S. at its expense. So it's not warning against doing a trade deal. It's saying, don't do a trade deal at our expense. And I think the reason they're saying this is because they understand that that is a win for the United States to try to create a larger trading bloc of negotiating power to then go use as leverage in a discussion with China. So China criticized countries making trade deals with the U.S. at its expense, warning of reciprocal countermeasures against those who appease Washington amid the ongoing tariff war. While others face a 10% U.S. tariff, China is hit with levies up to 145% and is retaliated with 125% duties on U.S. goods. Beijing's Commerce Ministry stated appeasement will not bring peace and compromise will not be respected. It warned that seeking benefits at the expense of others' interests is to seek the skin of a tiger, and such actions will ultimately fail on both ends and harm others. So I think, if we're playing chess, that's the piece the U.S. is angling for, and China's clearly angling to defend that piece. So I think I can understand what the success looks like. I cannot tell you how we achieve it, given the incentives of other countries and them wanting to stay in the middle. I think it's really hard to throw that net of incentives around other countries without China feeling like those countries taking those actions as offensive. Really hard. So anyway, D-Chat, I'm not disagreeing with you in any way, man. I'm just maybe trying to throw out something that I think would look like success to the administration, though I do not know what the probabilities are of it happening. Pardon the FTX guy and make him the Fed president. Issue a token and buy stuff with the token and then rug pull. Matthew Stevick says, pure stupidity plus most stubborn man of all time. I'm 42, New Jersey resident. My entire life, Trump has been in my life. I know this guy more than most. I used to be made fun of in college for my love of Trump. Now I've seen enough. The guy is legit crazy. There's a lot of buyer's remorse out there. I saw on Twitter. I think a guy I follow, Mark Dow, said he just posted something. I think he said I was wrong about Trump. I was too positive. I think he said. All right. People are pissed. I can see it. All right, let's keep going. I'm curious how people are thinking about Mag 7s here. Because the hard part about this is anyone that bought them up at that 350 level, and Microsoft, for example, you are now getting put to the test. I am into, here's the hard part, that vol is so expensive on this stuff that it's really hard to take a risk-defined bet to the upside. In other words, it's hard to use options which are super capital efficient in a way where you can minimize your capital exposure and get upside here. You can try to use verticals, which will sort of offset the expensive vol you're paying a little bit. But I sort of think it's interesting to trade against this low. Am I the only one? Am I the only one that thinks, not on everything, but on something like Microsoft, I'm sort of interested in trading against this low in a really, really cheap fashion, buying a upside vertical for 10 handles or something like this, the 360, 370 upside vertical. And just trading against this low and seeing if we can find a little bit of a double bottom. Not saying we won't pull the rug out at some point in the future, but I'm a little bit interested in the setup on a handful of these things, not everything, right? Like, do I think Netflix is strategically important, even though it's doing pretty well? No. Do I think, I don't know, Apple's, I suppose, a little bit different character. But there's some part of me that's looking at this Microsoft thing, this Microsoft move, and saying I kind of want to bet against that low and that low holding for a little bit of a bounce. You tell me if I'm crazy. I get all the reasons why. Maybe that's not, it's not an interesting fundamental bet. A lot of other people are catching up in the LLM race against OpenAI. But I still find it a little bit interesting here. Microsoft's been going down for a year, though. The stock is sick. I agree. That's sort of the point, though. My point is that 470 was like sort of just peak AI, peak OpenAI fervor. And it seems like I want to be accumulating when that is going away. And this previous high, which is held, was 340. So it's got historical significance here at 340. And it's exactly where it held last time. If you break it, you've got a bit of an air pocket below. So I don't want to go all in and with a bunch of stock exposure. I just like betting against this low one more time with maybe a cheap call vertical, something where I can offset the expensive vol in the stock. Maybe I'm wrong, but I take bets like this all the time. Poor man's covered call, front month premium is juicy. That's interesting. The problem is I kind of like it. It's probably more exposure than I want, though. Short Berkshire, says Mark. That's probably one of the most contrarian calls you can make right now. Other than, I'll give you one. I don't know why. I think this is the most disgusting chart out there. The home builder chart is gross. But I can't help feeling like at some point this is where I'm going to want to be. I just can't figure out what price. Is it like $60? You know? How far does this thing go down? Because this home builder chart is absolutely disgusting. And betting in favor of home builders, that's the crazy thing. But we're about to drop rates 100 basis points, right? That's going to help mortgage rates, right? So wouldn't the market be seeing through that? Right? If you're going to drop short end rates and you expect the long end rates to go down, well, that's going to help housing, right? So why are the home builders getting destroyed? In fairness, it took equities. Let me try to find it. So this is September's the point at which we started cutting rates in the U.S. And this was the peak of home builders. Because that's, you start cutting rates, what happened? Long end rates started lifting. So in fairness, the home builder stocks themselves did not anticipate what was going to happen with the long end of the curve. So in fairness, there was no sort of like anticipation of what was going to happen with long end rates here in equities. Victor, do you think we could talk about collars on SPY or QQQ in this environment? I've been doing covered calls, but not the other side. Yeah, I mean, there's not much to talk about. I think you're in a rich vol environment, which means your puts are going to trade expensive. So if you don't want to have a capital outlay, if you want to be using your calls to pay for the downside puts, you're going to have to skew. You're going to have to give yourself less upside on the call and come in closer. And then in order to pay for a put that is, it's not going to be equidistant, is what I'm saying. That's the easiest way to say it. So that's one. Number two is picking price. And this is hard, right? Timing the market is incredibly difficult. You never know. But I think you probably want to pick your price as well as you can. So for example, when we talk about 5,500 is likely going to be is fair value, we could see a retest here. And we ended up seeing a retest and a fail. Well, getting up to the 5,500 is probably where it's the most interesting point. It's easy to say in hindsight, but I think in fairness to me, we've been talking about this 5,500 plus or minus 300. So once you get back up to 5,500, even though you're starting to feel like there's momentum, if you're staying mechanical and you believe in the numbers that you have, then you sell your upside there. To get some downside protection. Here, you're sort of mid-range on the downside. I wouldn't look at this level and think this is the most advantageous level to sell my calls. But the problem is you never know what happens tomorrow, right? We could just blow out through the bottom of this and you could be thinking, man, I really wish I would have sold those calls to help pay for downside protection. I don't know what happens tomorrow, Mark. I think it was Mark or Brian. If you have the ability to scale and not knowing what the position size is, I would think about scaling. Maybe you put some on now in the off chance, in the chance that you get a little bit of a rally to 5,500, you put some more on. That's the way I would be thinking. I don't love to lock myself in at a single price. And so if my trade size is large enough and I've got a couple bullets, I start scaling in so that hopefully I give myself room to get the better price. But if it's not going to go with me or for me, at least I've got some protection on. I guess that's the way I would think about it. Victor, I already did that one. Short consumer staples would be another highly contrarian move. Maybe, but I think that's where all the subsidy money is going to go, right? Like when you can't consume anymore, I think the money comes from discretionary. It goes to staples, which is where that flow of money, why money goes there. But if you believe this will be longer dated and protracted, I just don't see an off ramp here in the next 90 days. So I do agree it's the super contrarian move here, Theta Trader. And I think if you see some world where an off ramp is had in the next 90 days, I'm not mad at looking at shorting staples as a contrarian bet. I just don't see that world. Now do AMD. Jesus. $85. That's wild. I cannot believe that. Imagine it, looking at all those paper gains just disappearing in a year. Flip-flop surfer says hopium, wishful thinking. I don't know what you're referring to. I'm in Nike calls. Ugh. God, look how cheap they got. That's insane. Insane. If that doesn't tell you what's on the horizon, I don't know what will. That's telling you the consumer is all but stopped. Like a cardiac arrest. There's so many problems. That's consumption, that's Vietnamese manufacturing threats, tariffs, that's probably dollar. God, that's all your problems in one chart. Brian, 100 shares of SPY and QQQ in my Roth. I get it. So not a ton of room to scale in, my friend. Which in one way it makes price even more important, but it only makes it important to the upside. So if you're not being greedy here, Brian, if it's not about greed, if it's about protecting, then I don't know. I would probably. My guess here, Brian, is to you it's more about capital preservation than it is being greedy to the upside. If you're starting to think about using the capital to buy something on the downside, and if you're already thinking that, that probably means you're a little bit nervous. And I tend to feel like whenever I get to that point where I'm starting to feel uncomfortable, I want to protect my risk. And if I miss a little upside, you're already going to miss the upside because you're selling calls anyway. So perhaps the risk I'm talking about doesn't really matter. You're just saying, hey, I'm willing to forego the income so that I can protect my downside. So in your case, I don't know that I'd care so much about price, because I think you're selling calls anyway. I don't think that's really your issue. I think you want to feel comfortable navigating this environment. So I get it. And maybe the price it's not really relevant as I mentioned earlier. Who's buying a new home if there's stagflation, recession? Ben, I agree 100%. But what I'm sort of saying is that everything's a cycle, right? And you're starting to see recessionary conditions being priced into equities. But my question is, what is the response and when is the response? Yeah, I think this gets worse before it gets better. I think I did a small nibble on home builders, I don't know, a month ago, a couple weeks ago. So I think these things are going to get murdered, but I think at some level they're going to offer a really interesting discount. And, after rates have done whatever they're going to do here, it's going to be time to build. After you've flushed out a lot of excess from the system, perhaps some pain has been experienced, it's going to be now time to start a new cycle. So I think it's early for this idea for sure, and that's why I said where's an interesting level to start buying in home builders here? Is it 60? Which is a significant discount to where we are now. Is it 50? Is it 40? Is it 30? I don't know. Long gold, go on vacation, says Jeremy Wallace. I'm not mad at that either. A lot of you guys know 2022. I saw the world through just two. I don't love to do this through a binary. It's either left tail. We take our medicine and we go through deflation, and what holds its purchasing power well during deflation? Gold. You also have other risks you can get around, like banking risk types of things like this. And on the right tail, there was, how do you get around these problems? It's you print funny money. And what's a decent inflation hedge in that world? It's gold. So I saw we either take medicine we never want to take, or we print a bunch more than people expect to try to get through our next set of problems. And in both of those scenarios, I wanted exposure in Bitcoin and gold. And so I talked about it a lot through 2022. I want to say gold and silver. So I'm not mad at people for wanting gold now. I think they're a little late, I'm not mad at that. But if you're one of those people who are hoping for a sort of an off-ramp, I think gold, at least on a short-term trade, probably it has some problems. As soon as that off-ramp gets announced, I think gold's going to have some issues. So if you see that coming in the next 90 days, then you got to be sort of prepared for that. I personally don't think it happens the next 90 days, so I'm not mad at anybody for looking at gold. I think the miners that we had been thrown out on this channel, on this show in particular, I've been talking about the miners and how they were cheap relative to the price of gold, that if you wanted some exposure to gold but you didn't like the idea of buying the highs, then some of these miners offered really interesting discount. And, people clowned it, or they poo-pooed it, or whatever. And then you get a week where Newmont Mining goes up 26%, So yeah. Rising tide lifts all boats, you know what I mean? So now it's getting hard to find relative discounts. This 60 number has been a line in the sand for Newmont. Probably hard to break through it, but if we can, I'm not selling here. I think we ultimately go challenge those previous highs. Ajit says gold is too manipulated. It is, but on both sides it seems. We've had a U.S. system that's tried to manipulate gold lower, and it seems like right now we've got a Chinese counterbalance that wants gold higher. So maybe two sides trying to manipulate the price is actually good price discovery. Maybe we finally have real price discovery in gold. People will run out of bread to buy and or allocate. I think Ajit, I think that's very, very true. I think the hardest part about this cycle is going to be trying to figure out how to layer in. I think the potential to go much lower than people expect, I think that's a real risk, but I also think that the counter response for monetary policy or fiscal policy dominance, I just think ultimately it's going to be too great. I don't think fearing the downside pays. The U.S. must refinance $28 billion of debt in the next 4 years, $28 billion out of $36 billion worth of debt. Yeah, bro. Add $80 billion of unfunded Social Security and Medicare liabilities to that. That also has to be financed in the next 10 years. Theta Trader just nailed it. All right, we're going to take us out on this one. Imagine trading the NASDAQ around the Millennium crash. Drops 50%. You go all in thinking you're getting a deal, then it drops another 50%. And I think that's the scenario you have to worry about. Going all in too early versus scaling. All right. I thoroughly appreciated this one. I know we didn't have a ton of totally actionable ideas, but frankly, I don't see a ton of stuff. I think we're mid-range S&P, so it's hard to take a bet in either direction. It's probably decent iron condor or kind of a decent vol selling area, but I wouldn't sell naked downside. I don't think I want to sell naked anything here, but I definitely wouldn't sell naked downside. Vol still elevated in backwardation. I think you have to remember, every time we got pretty decent high volatility, they would crush it. We would crush vol so quickly. And the fact that we're hanging around in not just backwardation, but like 30 VIX with backwardation, I think it's a spooky market out there. It's spooky. And for that reason, I am long stock. I am short NASDAQ futures over the top to reduce my portfolio delta. And I'm part of me wonders whether or not short NASDAQ is really the right instrument. Maybe 2 months ago, short NASDAQ was the right instrument to have short over my portfolio. At some level, I'm wondering if right now I'm getting value being short NASDAQ, or if I should pick a different index to lower my portfolio deltas. But that's for another day. I'm long Bitcoin. I am long silver. And yeah, that's kind of a lot of what I'm doing here. I'm long physical gold, physical silver, and I'm long the miners. Not much has changed. And I think the more growth scare that gets priced in the market, the more I'm going to want to find materials and material stocks. One, because I think those will be the protected areas. Those are really needed in a few industries. So yeah, my lean has not changed. I want to be long Bitcoin because I think this ends the way it always ends, and so I want to give myself exposure to the right side of the distribution. And I'm going to pick up a little bit of sort of interesting tech names here, but I didn't have FOMO on the way up, and I'm not going to have FOMO on the way down. Microsoft bet to trade against these lows is super short-term, one-cycle bet. Right? This is a 30 to 45-day bet. This is not a vote of confidence in long-term price holding. This is just, I wonder what happens if I hit this button. You know what I mean? We come down 340's been an interesting level of support. We're getting back down there again. A 360, 370 call spread. If I blow the money, I blow the money. But it's about a 50-50 bet right now. So not a ton of ideas here today, other than just sort of working through the probabilistic outcomes as I see them on the sort of the tariff negotiations over the next 90 days. Hopefully that you found some value in that, and reducing the portfolio exposure. You know, it keeps giving us retests of value areas. Okay, well, that's a good, instead of getting hopium like the rest of people will, we use that as an opportunity to sort of reduce our portfolio delta. But I'm not selling out everything. The way that I'm doing this is I'm selling futures against my portfolio that allows me to minimize my portfolio delta, but also keep some of my holdings. And if we continue to go down, then the short future is going to do well, create some additional cash, close out the hedge, or you can put it to work on new instruments or dollar cost averaging down. And your portfolio or your net lick stays relatively calm or stable. So that's the way I'm looking at this. And I will see you back here tomorrow for a conversation with Chris Vecchio. I think it's Chris. We might flip him around. I think actually this week it's going to be tomorrow's Ilya, and Chris is on Wednesday. So I appreciate you guys hanging around. Hit the like button if you haven't already. Follow me on Twitter at Victor Jones. The O in Jones is 0 because I like to be difficult. Give me your best memes and jokes about the Stephen A. hairline. You get them all in today. I don't want to hear them after today. Other than that, I'll see you back here, same time, same place, same great network, only on Tasty Live. Till then, peace.